We are live, ma'am. We can start.
Good morning. Welcome back. Today we are discussing with capital gains. Capital gains, the provisions of capital gains are contained in section 45 to 54H of Income Tax Act. Okay, section 45 to 54H of the Income Tax Act governs about provisions of capital gains. As always, here again we'll first discuss the basis of charge, meaning when will an income be called as capital gains? When will an income be called as capital gains? The basis of charge. There are five conditions to be satisfied in order to be in order an income to be called as capital gains. There are five conditions to be satisfied. Those five conditions are that there should be a capital asset. The first and foremost condition is there should be a capital asset. Second point, that capital asset shall be transferred, which means if there is no transfer, there is no capital gain. Point number three, as a result of that transfer, profit or gain shall arise. Okay, that is point number three. Point number four, transfer takes place in previous year. Okay, if you are computing income for assessment year 24-25, the transfer should take place in previous year 23-24. And this transfer is not exempt under section 54 to 54 GB. Okay, these are the five conditions to be satisfied in order to treat an income as capital gains. The first one is there should be a capital asset. Second point is that capital asset shall be transferred. Okay, so capital asset and transfer. We have to identify the definitions for these two terms as well. What is a capital asset and what is a transfer? Profit or gain arises from such transfer. Transfer takes place in previous year. The transfer is not exempt under section 54 to 54G. Say, we discuss about the exemptions towards the later end of the session. So first of all, let us see what is a capital asset and what is a transfer. What are the definitions for capital asset and transfer? The definition of capital asset is given by section 214 of Income Tax Act. There is an inclusive definition and there is as well as there are certain items which are excluded from the definition of capital asset. So the first thing which is to be included in capital asset is property of any kind. Property of any kind, whether it is fixed or circulating, movable or immovable, tangible or intangible, any asset is a capital asset. And that capital asset can be personal or it can be a business asset. That is, it can be used for personal purpose or it can be used for business purpose as well. Okay, so the first point is there should be a capital asset. That capital asset may be held for personal use or it may be held for business use. In either case, that will be called as a capital asset. So even if I sell my personal house property, I have to pay capital gains tax, right? Then the foreign institutional investors, they come to India and they invest in the Indian stock markets. So they continuously carry out the activity of buying and selling of securities. A doubt that was raised was that whether that income which is received from sale of securities, is it business income or is it capital gain? That is, they are continuously doing the business activity of buying and selling of shares. So the profit from sale of shares, whether that shall be treated as business income or capital gains. It has been held that security held by a foreign institutional investor shall be treated as capital asset, meaning income from that sale of security shall be treated as capital gain. So that is second point. Security held by a foreign institutional investor shall also be treated as a capital asset. Point number three, Unit linked insurance policies. Nowadays, insurance policies are treated as investments, and hence you take insurance policy for the purpose of getting money back during your lifetime. Earlier, the purpose of insurance policy was to compensate the death of the person, but nowadays there are policies called money back policies where you get money back at the end of a specific number of years, which means insurance policy is now a sort of investment, and hence when an investment is sold, you have to pay capital gains. So ULIP, where the insurance premium paid exceeds 2,50,000 per annum, whether on a single policy or an aggregate number of policies after 1st February 2021, that is also treated as a capital asset. So ULIP, which is taken after 1st February 21, will be called as a capital asset if the premium paid exceeds 2,50,000, either on a single ULIP or on aggregate ULIPs. Okay. Point number 4. A right to manage or control an Indian company is also treated as capital asset. Right to manage or control an Indian company is also treated as a capital asset, and that was introduced after the famous case law Vodafone. There was a case law between Vodafone and Income Tax Department, and where the Income Tax Department lost the case. And as a result, there was an amendment which was brought in capital asset as well as in transfer. Right to manage or control an Indian company. It's not a share. You don't have a share in an Indian company, but you have the ultimate voting right, or ultimate controlling right, not voting right, ultimate controlling right. Then the right to manage an Indian company is also treated as a capital asset. So these are the 2 items. These are the 4 items that have been included as definition of capital asset under section 214. Under section 214, the first one is property of any kind, whether it is a personal asset or a business asset. Second one is security which is held by foreign institutional investor. Third one is ULIP, which is issued after 1st February 21 and the premium paid exceeds 2,50,000 per annum. Fourth one is right to manage or control an Indian company. Now, what are the exclusions from capital asset? 4 items are excluded from the definition of capital asset. One is stock. Second is personal effect. Personal effect. I'll explain what is a personal effect. Agriculture, land and rural area, and the monetization certificates of the gold bonds or the special bearer bonds. So these are the 4 items which are excluded from the definition of capital asset. 4 items which are excluded from the definition of capital asset. First item is stock. Second item is personal effect. See, spam, we can call it as spam is not a capital asset. If we add together the first alphabets of all these 4 terms, stock is not capital asset, personal effect is not capital asset, agricultural land and rural area is not a capital asset, monetization certificates are also not capital asset. Now, what do you mean by personal effect? Stock, we all know. If you sell stock, you are paying tax in business income. It's not to be treated as capital gain. So stock is not to be treated as capital asset because it is already taxed under the head business. Personal effect means 2 conditions. You use an asset for personal purpose, and that is movable. So 2 conditions to be called for an asset to be called as personal effect is the asset should be used for personal purpose. It shall also be movable and personal. Then there is not capital asset. For example, if you sell your mobile phone, if you sell your personal motor vehicle, if you sell your household furniture, all these are capital asset, all these are personal asset, and these are also movable. Hence, when you sell your mobile phone, when you sell your motor vehicle, when you sell your household furniture, that is a personal effect. Personal effect is not capital asset, and hence there is no tax. On the other hand, if you sell your residential house property, it's agreed that it is held for personal use, but that residential house property is immovable. So it is not personal effect, which means it is capital asset. So if you sell your residential house property, you have to pay taxes. Okay, residential house property, if you sell, you have to pay taxes because it is not personal effect. Mobile phone, if you sell, it is not capital asset because it is personal effect, it is personal and movable. So in order to treat an asset as a personal effect, it is very much important that that asset is movable. Okay. Agricultural land in rural area. Agricultural land in rural area is again not a capital asset. So if you sell agricultural land in a rural area, it's not liable to tax. Monetization certificates, gold bond, special bearer bonds. These are certain bonds which are issued by the government. That is also not capital asset. Okay. But there are certain items which are excluded from the definition of personal effects. Agreed, they are personal, they are movable. They are personal and they are movable. Agreed. But people make profit by investing in these types of assets. Hence, these are not called as personal effects. They are excluded from the definition of personal effect. The items which are now I am going to explain, they are excluded from the definition of personal effects, which means these assets are capital assets. So which are the items that are excluded from the definition of personal effect, even though that criteria are followed, criteria are enjoyed? That is jewelry. I know jewelry is personal. It is held for personal use. It is also movable. I know that. But even then, jewelry is not included in the definition of personal effect. Jewelry is excluded from the definition of personal effect. So if you sell jewelry, you have to pay capital gains tax. If you sell jewelry, you have to pay capital gains tax. So the items which are excluded from the definition of personal effects are jewelry, drawings, paintings, archaeological collections. All these are excluded from personal effects, even though that even though that criteria like personal and movable are accepted, but they are excluded from the definition of capital asset, and hence they are capital asset. They are excluded from the definition of personal effects, and hence they are capital assets. So jewelry ultimately is a capital asset. Okay, it's not personal. But your mobile phones, your motor vehicles, your household furniture, all these are personal effects. There is no capital gains tax liability on its transfer. Okay. So once we have found out that there are two types of capital assets, once we have found out that there are the definition of capital assets, we have to divide capital assets into two types. There can be short-term capital asset and there can be long-term capital asset as well. There is a short-term capital asset and there is also a long-term capital asset. Okay, short-term and long-term. As the name specifies, short-term capital asset means it is a capital asset which is held for a short period of time. Let us see what is that short period of time. And long-term capital asset means an asset which is held for more than, an asset which is not short-term or which is held for a longer period. That is called as a long-term capital asset. Okay, asset held for a longer period is treated as a long-term capital asset, and asset which is held for a short period of time, that is called as a short-term. Now, what is that short period or a long period? For certain assets, in order to classify an asset as short-term or long-term, we look into the period of holding as 12. Like, if it is held for less than 12 months, it is short-term. If it is held for more than 12 months, it is long-term. Okay, less than 12 months, it is short-term. More than 12 months, it is a long-term. But certain assets to be called as short-term or long-term, we consider the period as 24 months. 24 months is the cutoff period. For certain assets, this is 24 months is the cutoff period for classifying as short-term or long-term. Okay. There are certain others for which the cutoff period is 36 months. So some assets less than 12 short-term, more than 12 long-term. Some assets less than 24 short-term, more than 24 long-term. For certain other assets, less than 36 short-term, more than 36 long-term. That is 1 year, 2 year, and 3 year. That is the period which we have to reckon. Now, let us first identify For which assets we consider 12 months for the purpose of classification. Which assets we consider the period of 12 months for the purpose of classification. There are 4 assets for which you have to consider 12 months for classifying the asset as short term or long term. Okay, 12 months for classifying as short term or long term. One is units of UTI. Units of UTI, if it is held for less than 12 months short term, more than 12 months long term. Units of equity oriented mutual fund. Equity oriented mutual fund. You invest in a mutual fund company and the mutual fund company uses those funds predominantly for investing in equity shares. So that is equity oriented mutual fund. Third one is a zero coupon bond, 0% interest. Okay. Issued at 80 rupees, maybe redeemed at 100 or 110. Redeemed at 100 or 110. That is a zero coupon bond. No interest received during the period of the bond. Everything you receive, the entire profit you receive at the time of redemption of the bond. Zero coupon bond also, you look into 12 months. Then any other listed securities like shares or debentures. Okay, for these 4 assets, the period which we have to consider for categorizing that asset into short term or long term is 12 months. If listed shares, let us take listed shares, that is under point number 4. Listed shares is held for less than 12 months, it is short term. If listed shares are held for more than 12 months, that is long term. Okay. So these are the 4 assets: units of UTI, units of equity oriented mutual fund, zero coupon bond, and other listed securities. Now, next category, which all assets we consider 24 months for the purpose of classifying as short term or long term. Which all assets we consider the period of 24 months for the purpose of classifying as short term or long term. Unlisted shares. Okay, unlisted shares. Immovable property, that is land and building. Immovable property. For these 2 types of assets, the period which you have to consider is 24 months. And all others, anything which don't fall under category 1 and category 2, for all others, the period is 36 months. Okay, so this is how we categorize an asset as short term or long term. So let me explain. If it is a listed share, we have to look into 12 months. Okay, for categorizing as short term or long term, the cutoff period is 12 months. For unlisted shares, it is 24 months. Okay, unlisted shares, it is 24 months. For listed debentures, again that is 12 months. Listed debentures, it is 12 months. Unlisted debentures, it's 36 months. Unlisted debentures. Okay, because 24 months is given only for unlisted shares. So unlisted debentures to be classified as short term or long term, you have to consider the cutoff period as 36 months. Any asset other than short term asset is called as a long term asset, meaning asset which is held for more than 12 or 24 or 36 as the case may be, will be classified as long term capital asset. And the capital gain on sale of short-term capital asset is called as short-term capital gain, and capital gain on sale of long-term capital asset is called as long-term capital gain. Now, we have found out the definition of capital asset. Now we look into the definition of transfer. What is transfer? The definition of transfer is given under section 247. The definition of transfer is given under section 247. Let us see what is the definition of transfer. What does transfer stand for? Transfer includes one, sale. Now, as for the Sale of Goods Act, there are 2 conditions to be satisfied in order to call a transaction as transfer. 2 conditions. One is there should be a money consideration. And second, there should be mutual consent of buyer and seller. Mutual consent of buyer and seller. That is the transaction which is called as sale. There is money consideration. Okay, point number 1, there is money consideration, and also there is mutual consent of buyer and seller. Only these 2 conditions are satisfied, that transaction will be called as a sale transaction. Only if these two conditions are satisfied, that transaction will be called as a sale transaction. So let us find out what is the difference then. What is exchange and what is exchange is also called as sale. Why exchange is also called as transfer? Why exchange is not called as sale? We'll understand from this. Sale shall include money consideration and also mutual consent of buyer and seller. Exchange, there is no money consideration. There is no money consideration. It might be only partly in money. That is what is called as an exchange. Even then, exchange is included in definition of transfer, though it is not a sale transaction. Okay. So, sale is discussed. Exchange is discussed. Okay. We have discussed what is sale. We have discussed what is sale, what is exchange. Now let us see what is compulsory acquisition by government. Compulsory acquisition. What is difference between sale and compulsory acquisition? As I just told you, sale should include mutual consent of buyer and seller. In compulsory acquisition, some of the cases there might not be consent of the seller when a property is compulsorily acquired by the government. So even when the property is compulsorily acquired by the government, that is called as transfer, the compensation received on compulsory acquisition is to be taxed under the head capital gains. Okay, so transfer also includes compulsory acquisition by government. Then there are two another terms now, relinquishment and extinguishment. That is also included in the definition of transfer. Let us see what is relinquishment, what is extinguishment. Relinquishment means relinquishment. The asset continues to exist there, but I have no right over the property. That is what is called as relinquishment. Say, I withdraw from an asset. I withdraw from an asset. Such a transaction is called as relinquishment. The asset continues to exist, but I have no right over the property. How do I explain that? An asset continues to exist where I have no right over the property. Assume that you own a piece of land. Okay, you own a piece of land. We entered into an agreement. We entered into an agreement to purchase a property. I entered into an agreement. I am the prospective buyer. You are the seller. So we had an agreement. I paid you advance. I paid you an advance of 1 lakh and the agreement was entered. I promised to pay the remaining sale consideration within a period of 3 months. 3 months is the agreement period, and at the end of 3 months, I will pay you the balance amount. I will arrange for the balance funds. I will pay you the balance, and then the property will be registered in my name. After 3 months, within a period of 3 months, what happened is, somebody else approached you. Say Mr. A approached you, and he agreed to purchase that same property for a higher amount. I had agreed to purchase the property for 50 lakh. Mr. A approaches you and he offers a consideration of 1 crore. Okay, he offers a consideration of 1 crore. We have an agreement, right? You and me have an agreement, but Mr. A has approached you for a consideration of 1 crore. I had agreed only for 50 lakhs. So definitely you will again come back to me. You will come back to me and you will ask me to withdraw from the agreement so that we can sell this property to Mr. A. I might agree to withdraw from the agreement provided you pay me a certain amount of compensation. So I told you, okay, I will withdraw from the agreement provided you give me 20 lakhs. 20 lakhs, then I will withdraw from the agreement. We will tear off the agreement. Okay, we'll put that agreement in the waste basket. You can sell the property to Mr. A. If you try to sell the property without my permission, then I may file a case. So you are selling this to Mr. A only after getting my permission. But in order to get my permission, you have offered me certain sum of money. You understand? Here the sale transaction has not taken place. Exchange has not taken place. Compulsory acquisition has not taken place. What has happened? I just tore a piece of paper. Agreement which was written by both of us. That agreement was cancelled. And for the cancellation of agreement, I get certain money, 20 lakhs. So the piece of land, the property there that continues to exist there, but I withdraw my right over that property. I withdraw my right in that property. I had a right in that property by virtue of an agreement, and now I withdraw from this property. I withdraw my right over this property. I get 20 lakhs, and that 20 lakhs will also be taxed as capital gains because that is what is called as relinquishment. Asset continues to exist there, but I have no right over the property. Asset continues to exist. That piece of land is still there, but I don't have any right. That is what is called as relinquishment. Okay. So now let us see what is the difference between relinquishment and extinguishment then. Relinquishment and extinguishment. Relinquishment means asset continues to exist, I have no right. What is extinguishment? Extinguishment means I have no right over the property because the asset itself is not in existence. I have no right over the property because asset has become extinct. Asset has become extinct. I have no right over the property. I have no right. Asset is not there. What is that then? Any compensation which is received on destruction of a property, damage of a property, like insurance claims received, shall also be taxed under this head. That is what is called as extinguishment. Relinquishment, asset continues to exist, I have no right. Extinguishment, I have no right because asset is not there. Asset has become extinct. Even then, that is taxed under that head, capital gains, because both relinquishment and extinguishment is transfer. Then we come to redemption of zero coupon bond. When I was explaining the term capital asset, I told you zero coupon bond means a bond which has zero interest. A bond which has zero interest. That is what is called as zero coupon bond. So I issue a bond at 80, you redeem and you get 110. The difference between 110 and 80 has to be treated as profit under the head capital. Next definition. Transaction under Section 53A of Transfer of Property Act. This we have seen in the definition of deemed owner in house property. This we have seen in the definition of deemed owner in house property, Section 53A of Transfer of Property Act. Normally, a land or building, if the ownership has to be transferred, registration is compulsory. That is Section 53A of Transfer Property Act specifically says. If you have to be called as an owner of land or building, the property has to be registered in your name. There should be a title deed to that property. Documents should be in your name. Okay. But if the property is not registered, instead, you take possession of the property on payment of the entire consideration. You just take the possession of the property on payment of the entire consideration. Then also you will be treated as owner. You will be treated as owner from the date on which you take possession of the property, even though registration has not happened. Even though registration has not happened, from the date on which you take possession on payment of full consideration, you will be treated as deemed owner. That is what the House Property Act says, the House Property Section says, Section 27 says. So the same logic is applied here. Your period of holding will be counted from the date on which you are the deemed owner. In other words, that taking possession on payment of consideration, that is also treated as transfer. Conversion of capital asset into stock in trade, I will explain separately. We have something to be explained further in that. I will explain that separately. Then the last case is disposing with an asset or even an interest in an asset is sold. Even an interest in an asset is sold. The shares are not held in your name, but you have an interest in that company. Even then, that will be called as transfer. So this is also called as transfer. Disposing or parting with an asset or disposing interest in an asset. Parting with interest in an asset is also treated as transfer. This was again introduced after that case law of Vodafone. Okay, an amendment which was introduced after the Supreme Court decision in case of Vodafone. So these are the definition of transfer. Let us recollect what is definition of transfer. It is sale, exchange, then compulsory acquisition, relinquishment, extinguishment, redemption, transaction under section 53A, conversion of capital asset into stock in trade, and disposing or parting with an asset or interest in an asset. Now, when is transfer complete? When is transfer complete? In case of an immovable property, transfer is complete on the earlier of either registration or handing over possession under section 53A. We have just explained that. Registration has not happened, but the possession is handed over. That will be treated as transfer, whichever happens earlier, either the actual registration or taking possession of the property, whichever happens earlier, that will be treated as the date of transfer. Okay, for an immovable property. But for a movable property, the transfer becomes complete upon delivery. The transfer becomes complete upon delivery. There is no requirement that the property has to be registered. When we purchase a mobile phone, you don't get it registered in your name. The moment the seller, the shopkeeper, he delivers the property, that is yours. So movable property, the transfer is complete upon delivery. But for immovable property, it has to be registered. Or, of course, 53 of Transfer of Property Act, taking possession happens earlier, then that can be treated as transfer. Next point, regarding period of holding, we have to consider some special rules. Regarding the period of holding, we have to consider some special rules. What are the special rules to be looked into for considering about the period of holding? Transfer of securities happen in a stock exchange. Okay, transfer of securities happen in a stock exchange. We all know that if it is a listed security, you cannot purchase it by yourself. There should be a broker, an intermediary. A broker purchases and sells shares for you. Broker purchases and sells shares for you. Okay. So the period of holding is calculated from the broker's note, not the date on which the company makes any entry. Okay, the period of holding shall be calculated from the date of broker's note. Whereas in case of securities which are unlisted, that is securities which are transacted privately, the period of holding shall be calculated from the date of contract. You would have entered into a share transfer form and all that. From that date, we'll be looking into the period of holding. So if it is security in a stock exchange, it shall be calculated from broker's note. If it is private security or an unlisted security, it will be calculated from the date of contract. If these are transactions, that are transfer, we have to now see what are the transactions which are not treated as transfer, which are not treated. For the time being, let me explain just one transaction. For the time being, let me explain just one transaction. Gift or inheritance is not transfer. Gift or inheritance is not transfer. Okay, for the time being, let us see only one point. Gift is not transfer. Okay, we have to find the applications of these gift in the later sections. There are a lot of other transactions which are not transfer. For the time being, we'll see only one. Gift is not transfer. Come to the format for computation of long-term capital gain. There are two formats. There are two types of capital gains. One is long-term capital gain and the other one is short-term capital gain. So we'll see into the format for computing long-term capital gain. We'll also see the format for computing short-term capital gain. Now, let's take a simple example. Before we identify the formula for computation of long-term capital gain, let us see a simple example. I purchased a property. The property was purchased in 2022-23. Or let me give you the exact date. The property was purchased in September 2022. That is the date of purchase. Date of purchase. September 2022. This was purchased for 5 lakh. Okay. Then in January 23, same year, initially when I purchased the property, there was only one floor. There was only ground floor. Okay. January 23, I constructed one more floor upon that. And that is called as improvement. That is what is called as improvement. Do you understand? So I constructed one more floor over the first floor and the improvement expense is 2 lakh. January 23, the improvement expense incurred is 2 lakh. Now what happened is in July 2000, no, let us make it February. February 2024, I sell this property. I sell this property for 25 lakhs. And at the time of sale, I paid a brokerage as well. At the time of sale, I paid a brokerage as well. Brokerage amount paid is 40,000. Brokerage amount paid is 40,000. So these are the few transactions that have happened. Okay, these are the transactions that have happened. September 22, I purchased a property for 5 lakh. January 23, I incurred further improvement expense of 2 lakh. February 24, I sell this property for 25 lakh. And at the time of sale, I have paid a brokerage of 40,000. First of all, what we have to identify is whether this asset is short-term or long-term. That is first we have to identify short-term or long-term. This is immovable property. Immovable property for the purpose of categorization as short-term or long-term, the cutoff period is 24 months. 24 months for an immovable property. For categorizing as short-term or long-term, the cutoff period is 24. That is, if it is held for more than 24, the asset will be called as long-term. If it is held for less than short-term, the asset will be less than 24, it will be called as short-term. So let us take the period of holding. The period of holding is from September 22 to February 24. There is no 24 months here. Except only if it is held up to September 24, 2024, it will be called as long term. Only if it is held up to September 2024, this will be called as long term. We have held this only up to February 24. So this is a short term capital asset. This is a short term capital asset. Okay, so let us see how do we compute profit. I have purchased for 5 lakh, improvement is 2 lakh, brokerage is 40,000. This is my expense. This is my expense. Brokerage is also my expense. And this is the receipt. Sale consideration received is receipt. So how do we compute profit? Pretty simple a format. Pretty simple. What is that? First of all, take sale consideration. Sale consideration is 25 lakh. Okay. Deduct all the expenses like cost of acquisition. Cost of acquisition is to be deducted. Cost of improvement is to be deducted. Okay. Cost of improvement is to be deducted. And we have also to deduct one more expense, that is a selling expense. We call it expenses on transfer. Expenses on transfer. That is also to be deducted. These are the 4 items that are to be deducted. Okay, 4 items. Cost of acquisition, cost of improvement, and expenses on transfer. When you deduct all these 3, what do you get? That is what is called as short-term capital gain. So I deduct 5 lakh, I deduct 2 lakh, and I also deduct 40,000. The difference which you now get is called as short-term capital gain. Short-term capital gain. So short-term capital gain is 25 lakh minus 5 lakh minus 2 lakh minus 40,000. 17 lakh 60,000. This is how we compute capital gain for, this is how we compute capital gain for a short-term capital asset. Do you understand? This is short-term capital asset. What is the format? Format is for short-term capital gain, sale consideration, less cost of acquisition, that is purchase cost, less cost of improvement, less expense on transfer. Now, another question is, this is brokerage on sale of the property. Okay, this is brokerage on sale of the property. What if you have paid brokerage on purchase of property? Purchase of property, if you have paid brokerage. Purchase. What shall be done with that? I paid a brokerage of 20,000 when I purchased the property. Any expense paid at the time of purchase shall be added to the cost of acquisition. To the cost of acquisition. So if you have paid 5 lakh and 20,000 as brokerage at the time of purchase of property, then your cost of acquisition will be called as 5 lakh 20. So the expenses on purchase will be added to cost and then deducted from sale consideration. Okay. Expenses on purchase will be added to the cost of the property and then that will be deducted from sale consideration, whereas expenses on transfer will be separately deducted from sale consideration. There is a special line for deducting expenses on transfer, whereas expenses on purchase, we don't have a separate line. Instead, that will be forming part of cost of acquisition. So this is a format for computation of short-term capital gain. Computation of short-term capital gain. Now let us see what is the format for computation of long-term capital gain. Format for computation of long-term capital gain. Let me continue this example. There is a property. This property is purchased in, let me change the date here. This was purchased in September 2001. Okay, September 2001. The improvement expense was incurred in the improvement expense. See, some 20 years back, the property is purchased, that is in 2001. And the improvement expenses were incurred in the financial year 2019-20. And now in 2023-24, you are selling this property. This was purchased for 50,000. Now you are selling this for 75 lakhs. This is the question. You have purchased a property in September 2001. Date of purchase, the amount of purchase is 50,000. Then improvement expenses have been incurred in 2019-20. Amount of improvement expenses 2 lakh. The property is sold in 2023-24 for an amount of 75 lakh. 75 lakh, you have sold this property. What is capital gain? In this case, we see that the property is a long-term capital asset. The property is a long-term capital asset. How do we call this property as long-term capital asset? The property is held from September 2001. See, I'm holding this property for around 20 years, 23 years. So this property is long-term capital asset and hence it is called as a long-term capital gain. Now the format for computing long-term capital gain is slightly different. Again, sale consideration 75 lakh. Instead of cost of acquisition, what I deduct is indexed cost of acquisition. Indexed cost of acquisition. Indexed. See, indexed cost of acquisition just means, if we put in simple terms, indexed cost of acquisition is present value of actual cost of acquisition. Present value of actual cost of acquisition. If you have studied financial management, you would have known that the value of money keeps on changing over a period of years. Over a period, the value of money keeps on changing. If we say this value of this property as on September 2001 is 50,000, see, what is the value of 50,000 now? What is the value of 50,000 now? In financial 23-24, what is the value of 50,000? I'm not talking about value of the property. I'm asking about the value of money. Value of money. The 50,000 then, 2001, if you talk about 50,000, that might be worth around 5 lakh. At that time, its value would have been about present 5 lakh. Okay, we would have heard about our grandparents talking that at the time of their marriage, the value of gold was only 1,000 rupee or 2,000 rupee. Okay, now the value of gold is around 50,000 per gram, 50,000 per sovereign. Now at their time, the value of gold was only around 1,000 rupee or 2,000 rupee or 100 rupees. You would have heard about our grandfathers talking about that, grandparents talking about that. Now, when you say that the value of gold then was only 1,000 rupee or 2,000 rupee, you also have to identify something. Their income during those times were only maximum maybe 20 to 25. Income at that time was also only 20 to 25, hence gold value was only 1,000. Now the income has increased in lakhs. Most of the persons, they earn their income in lakhs. So the value of gold has also increased proportionately, which means the value of money keeps on changing over a period of time. This principle you would have discussed in financial management. And we identify the present values of money by using certain formula, the annuity table, the discounting rate, using all those, we identify the present value of money. So I want to know what is the present value of 50,000. Value. What is its present value? In order to identify the present value, we don't use annuity table here as in financial management. We don't use annuity table. Instead, the income tax department use something called as cost inflation index. Cost inflation index, or it is called as CII. The cost inflation index is also called as CII. There is a short form which we call it. Index means always a base. That is what is called as index. There is always a base here. We have taken 2001-2 as the base year. 2001-2 is the base year. Okay. And we assume that we take 100 rupee as the base figure. As we explained in the case of percentage, here also we take the base year value at 100. Okay, the value is 100. Base year, the value is 100. Now 2002-3, something which we could purchase for 100. Something which we could purchase for 100. If you are going in 2002-3 and you are trying to purchase it. Okay, if you are going in 2002-3 and if you are going to purchase it, you may not be able to purchase that same product. You may not be able to purchase that product for an amount of 100. You may not be able to purchase that amount, purchase the same quantity of the same product in the next year for 100 rupees. Why? What is the reason? What is the reason you may not be able to purchase the property for 100 rupees? Because of inflation, you may have to pay a higher amount. You may have to pay higher amount. So the item which you could purchase for 100 in 2001-2, you have to pay 105 in 2002-3. For purchasing the same product and you purchased in 1-2, if you went in 2002-3 to purchase the same property, you had to pay 105. What does that mean? Value of 100 in 2001-2 is equal to 105 in 2002-3. 100 has now become 105. Is it not the meaning? Value of 100 in 1-2 has now become 105. 2003-4, you again tried to purchase the same property. Now you have to give 109. So the 100 in 1-2 is 109 in 3-4. 105 in 2-3 is 109 in 3-4. Okay, every year we have designed CII, and that is determined by the government in consultation with the Economics Department of India and the Statistical Departments of India. In consultation with all these departments and comparing the inflation that has happened over a period of years, they designed this CIIs. 2004-5, again, if you go to purchase this property, again, the value has become 113. That way, we have CIIs which have been fixed for the various financial years. See, 122, 129, 137, 148, 167. For the various financial years, we have fixed CII. You need not learn these by heart. That will be given in your question. Whatever CII which is relevant for your calculation will be given in the question. So as in 23-24, the CII has now become 348. Each year there has been inflation, and as a result of inflation, the value of money has changed. Okay. So 2001-2, if the value is 100, now it is 348. 2002-3, if it is 105, now it is 348. The 2003-4, the 109 of 2023, 109 of 2003-4 is 348 of 23-24. Almost 3.5 times the value of money has increased. 100 has become 348 means it is 3.5 times. Okay. This is the inflation that has happened over a number of years. 100 has become 105. 105 has become 109. So you may compare, you may identify the value of any number of years by this calculation. You may calculate CII for any number of years. You may calculate the present value of any amount with this table. One more thing, if the asset has been purchased before 2001-2, then also we take the base year of 2001-2. Even if the asset is purchased in 1999, you can compare that only with 2001-2. 2001-2 is the base year. Okay, so let us now come to this example. I have purchased a property in September 2001. September 2001 means the financial year is 2001-2. Financial year is 2001-2. I have purchased a property in financial year 2001-2, and the value at which the property is purchased is 50,000. Value at which the property is purchased is 50,000. Okay, 2001-2, the property is purchased. Let us compare with this table. Let us compare with this table. An amount of 100 in 2001-2. If 2001-2 amount of 100 has become in 2023-24, this has become 348. Is it not? An amount of 100 in 2001-2 has become 348 in 2023-24. Rupees 100 of 2001-2 is equal to rupees 348 of 2023-24. That is the meaning of this table. That is the meaning of this cost inflation index. Rupees 100 of 2001-2 is equal to rupees 348 of 2023-24. Similarly, rupees 105 of 2022-23 is rupees 348 of 23-24. Rupees 109 of 2003-4 is equal to rupees 348 of 2023-24. So if 100 of 1-2 is 348 of 23-24, what is 50 of 1-2? What is the present value of 50,000? What is the present value of 50,000? How do we multiply? 50,000 into 348 divided by 100. 50,000 into 348 divided by 100. That is how we calculate the present value of 50,000. If 100 has become 348, what is present value of 50,000? Okay. But how do we explain this in the form of a formula? Let us put it in the form of a formula as well. The method to calculate index cost of acquisition, let us explain the form of formula. The formula is actual cost of acquisition into CII for the year of transfer. CII for the year of transfer 2023-24. This has to be divided by which CII? which CII you would divide this with? CII for the year of acquisition by the SSC. Year of acquisition by SSC. CII for the year of transfer divided by CII for the year of acquisition. So this is how we have derived it. Index cost of acquisition. Index cost of acquisition is equal to actual cost of acquisition into CII for the year of transfer divided by CII for the year of acquisition. So 50,000 into. See, always try to remember that the higher CII comes in the denominator part. Higher CII comes in the numerator part, okay? The higher CII numerator, the upper part, higher CII comes because we have to increase the value of asset. So we have to multiply by a higher amount. We have to multiply by a higher amount. So the upper part contains a higher value. That is just the logic. If we have to increase, we have to always multiply by a higher amount than the lower amount, the denominator. So the value is 50,000 into 348 divided by 100. This is how we identify the cost of acquisition. This is how we identify the cost of acquisition. Index cost of acquisition. 1,74,000. Similarly, we have to calculate one more item. What is that item? We have to calculate index cost of improvement. Index cost of improvement. Index cost of improvement. See, 2019-20, you have incurred an improvement expense of 20,000. What is its present value then? What is its present value? Again, let us go to that table. Let us go to that table regarding indexation. CII 1920 289. 289 of 1920 is 218 of 1929 is 348 of 2324. 348 of 2324. 1920 289 is equal to 2324 348. So how do we calculate? How do we calculate? 2019-20 and let us make two tables, 2019-20 and 2023-24. 2019-20, 289 is equal to 348 of 23-24. 348 of 23-24. So, we have incurred 2 lakh. 2 lakh in 1920. What is its present value? 2 lakh. What is the present value of 2 lakh? It's 2 lakh into 348 divided by 289. Or what is the formula for improvement? What is the formula for improvement? Formula for improvement is actual improvement into CII for the year of transfer again. CII for the year of transfer. Divided by, what shall be divided with? It is CII for the year of improvement. CII for the year of improvement. So this is a formula for calculating index cost of acquisition as well as index cost of improvement. So let us calculate index cost of improvement also. 2 lakh into 348 divided by 289. 2 lakh into 348 divided by 289, that will come to 2,40,830. Expense on transfer, it's not to be indexed because expense on transfer you incur in this year itself. Expense on transfer you incur in this year itself. So that is not to be indexed. Expense of transfer is 40,000. The balance which we get now is called as long-term capital gain. The balance which we get now is called as long-term capital gain. 75 lakh minus 1 lakh 74 minus all those items. This is long-term capital gain. Sale consideration less index cost of acquisition less index cost of improvement and expense on transfer. Only long-term capital assets are indexed. Short-term capital assets are not indexed because short-term capital asset, we all know that it is held only for a short period of time, and within that short period of time, we assume that there is no much variation. There is no much variation that has happened in the value of money. No much variation has happened. Agreed, there will be a slight variation, but it's only a period of 2 to 3 years, maximum 3 years. Within that maximum 3 years, there is no huge variation that has happened in the value of money, and hence for short-term capital assets, there is no indexation. We index only for long-term capital assets. Okay, only for long-term capital assets. This indexation principle is applicable. So the indexation principle is based upon some financial management aspect. Financial management, we find out present value. Here also we find out present value. But the method of calculating present value is different from that of financial management. There we use annuity table. We have cost inflation index here. So the idea has been developed from idea of indexation has been developed from financial management principles. So this is how we compute long-term capital gain. So let us find out the format for computation of long-term capital gain. Long-term capital gain is equal to sale consideration less index cost of acquisition less index cost of improvement less expense on transfer. What is index cost of acquisition? Actual cost of acquisition into CII for the year of transfer divided by CII for the year of acquisition. We have explained that. Index cost of improvement is equal to cost of improvement into CII for the year of transfer divided by CII for the year of improvement. Now, there is no indexation in the following cases. Okay. Even though all long-term capital assets have to be indexed, certain assets, even though they are long-term, that is not to be indexed. Certain assets, even though they are long-term, that is not to be indexed. The 5 cases are short-term capital gain, we all know there is no indexation. Bonds and debentures, there is no indexation. Bonds and debentures. Depreciable asset, there is no indexation. Depreciable asset, I have explained that. Slum sale, there is no indexation. Slum sale. Again, we are going to discuss about that in detail. Then NRI, who has purchased shares and debentures in an Indian company utilizing foreign currency. There is no indexation. So these are the 5 cases. Short-term capital gain, we all know there is no indexation. Bonds and debentures, there is no indexation. Depreciable asset, there is no indexation. Slum sale, I'll explain separately. Then NRI acquiring shares and debentures in an Indian company, there is also no indexation in that. Okay. Let us just see what does all these terms mean. What do you mean by sale consideration? What do you mean by cost of acquisition? What do you mean by improvement? What is expense on transfer? All those things. Sale consideration means a consideration received in place of assets transferred. Consideration receivable in place of assets transferred. It may be received in cash or in kind. It may be received in cash or in kind. If it is received in kind, what is taken as sale consideration? Fair market value is taken as consideration. Okay, so sale consideration means consideration which is received in place of assets transferred. This consideration may be received in cash or in kind. And if it is received in kind, what is taken as sale consideration? Fair market value is taken as sale consideration. What do you mean by cost of improvement? Cost of improvement means capital expenditure which is incurred for additions or improvements in increasing the value of asset. Okay, capital expenditure which is incurred for making additions or improvements in the value of asset. After purchase, if you have incurred any capital expenditure, not the current repairs, that is what is called as improvement. Expenditure incurred prior to 1/4/2001 is ignored. That's not considered. Only improvement expense incurred after 2001 is considered. And the interest which is allowed as deduction under 80EE or 80EEA, the Chapter 6 says, that are not to be treated as cost of improvement again under capital gain, for which we have already claimed deduction. Again, you cannot claim deduction in capital gain. Double deduction is not possible. What do you mean by expense on transfer? Expense on transfer means brokerage, commission, stamp duty, traveling expense, litigation expenditure, etc. And there is no deduction for securities transaction tax. For a person who is engaged in the business of buying and selling shares, that income will be taxed as business income, and then he can claim deduction for securities transaction tax. But a person for whom the shares are not the stock in trade, person for whom shares are not stock in trade. For example, my case, I don't trade in shares, but I occasionally purchase shares, occasionally sell them. I occasionally purchase shares, occasionally sell them. So I treat these shares as investment, as my capital asset. When I sell this shares in the stock market, I'll be paying securities transaction tax, but there is no deduction for securities transaction tax. The reason is there are certain other advantages which we enjoy for these shares which are sold in stock exchange. We'll deal with that separately. So there is no further deduction for securities transaction tax. Okay. Now let us see what is cost of acquisition. We have seen what is sale consideration. We have seen what is cost of improvement. We have also seen what is expense on transfer. Now let us see what is cost of acquisition. Cost of acquisition generally means actual cost of acquisition. Generally means actual cost of acquisition. But in certain cases, cost of acquisition means notional cost. Notional cost means something other than the actual cost is taken as my cost of acquisition. My cost of acquisition is not actually my cost. I take some other figure as my cost. That is opposite of real. That is what is called as notional. Which are the cases where we pay something other than the actual cost as something other than the actual cost as notional cost? There are 6 cases. There are 6 cases. For the time being, we'll discuss 4 cases. For the time being, we'll discuss the important 4 cases where something other than the actual cost is taken as cost of acquisition. Let me explain with an example. Take Shah Rukh Khan. Shah Rukh Khan and then his son, Aryan Khan. His son, Aryan Khan. Okay. Shah Rukh Khan purchased a property in 2004-5 for rupees 50,000. All right. This property was, let us take Shah Rukh Khan incurred some improvement expense as well. So this is 2004-5. He has purchased the property. He has purchased the property. In 2014-15, he has incurred improvement expense. 2014-15, he has incurred improvement expense. Improvement expense incurred is 2 lakh. Now what happened is 2022-23, Shah Rukh Khan gifted this property to Aryan Khan. Gifted this property to Aryan Khan. All right. So as we all know, for a gift, the sale consideration might be 0, or it can also be an inadequate consideration, but here it is assumed that sale consideration is 0. Sale consideration is 0. Shah Rukh Khan has gifted a property in 2022-23 to Aryan Khan. So Aryan Khan's actual purchase cost is 0. Actual purchase cost of Aryan Khan is 0. Okay. Now in 2023-24, what happens is Aryan Khan is selling this property. Selling this property for 5 crore. These are the transactions. So let us recollect that Shah Rukh Khan has purchased a property in 2004-5 for 50,000. In 2014-15, some improvement expense have been incurred by Shah Rukh Khan on that property for 2 lakh. 2022-23, Shah Rukh Khan sells this property to his son Aryan Khan, and the purchase cost for Aryan Khan then is 0. Sale consideration of Shah Rukh Khan is 0. And Aryan Khan is selling this property in 2023-24 for 5 crore. We know that gift is not transfer. Gift is not transfer. Okay. Gift is not transfer. What does it mean? Who has gifted the property? Who has transferred the property? Shah Rukh Khan has transferred the property, but that is not treated as transfer. So no capital gain for Shah Rukh Khan. No capital gain for SRK. Do you understand this? There is no capital gain for Shah Rukh Khan. SRK need not pay any tax. SRK need not pay any tax because gift is not transfer. Gift is one transaction which is not treated as transfer. There are so many other transactions which are not treated as transfer, but for the time being, let us take only one, that is gift. Now, what happens in 23-24? Aryan Khan is selling the property. We have to compute his capital gain. Now, we are computing capital gain of Aryan Khan. Capital gain of Aryan Khan is calculated. Sale consideration of Aryan Khan is 5 crore. Now, actual cost of Aryan Khan is, what is actual cost? 0. Actual cost. But that is not taken as cost of Aryan Khan. What is taken as cost of Aryan Khan? Previous owner's cost. Previous owner's cost is taken as cost of acquisition of Aryan Khan. Previous owner's cost, meaning cost of Aryan Khan will be Shah Rukh Khan's cost, SRK's cost, that is 50,000. So when do you apply this case? When do you apply this case? Section 49(1), that is the section which says that you have to take your cost as previous owner's cost. Take your previous owner's cost as your cost. In which case, when this section is applicable, I will take my cost as my previous owner's cost when I have acquired a property by a transaction which is not transferred. I have acquired a property by a transaction which is not transferred. And what is that example of a transaction which is not transferred? Gift. Gift is an example of such a transaction. Gift is an example of such a transaction. I have acquired a property by gift. Then my cost is previous owner's cost. Do you understand when 49(1) is applicable? When 49(1) is applicable. 49(1) is applicable. That is, you have to take your previous owner's cost as your cost. When you have acquired a property by a transaction which is not transfer, and one example of a transaction which is not transfer is gift. So when I receive a property as gift, my actual cost is 0, but my cost will be taken as previous owner's cost. What are the additional conditions in this section? 49(1). Whenever you take previous owner's cost as your cost, your period of holding shall also be counted from that previous owner's period. That is, to find out whether this asset is short-term or long-term. To find out whether this asset is short-term or long-term in your hands. In order to find out whether this asset is short-term or long-term, consider previous owner's period also. If you are taking previous owner's cost, take previous owner's period also. Take previous owner's period. So, Aryan Khan would be assumed to have held this property from 2004-5. From 2004-5, even though the asset was acquired only by him in 2022-23. Even though Aryan Khan got this asset only in 2022-23, it is assumed that he has held this property from 2004-5 itself. Whenever you take previous owner's cost, take previous owner's period also. So this is long-term capital asset in the hands of Aryan Khan. When you count from 2004-5, this asset becomes long-term in the hands of Aryan Khan. Okay, this is long-term. So we have to index it. 50,000 into CII for 2023-24. CII for 2023-24. Now divide by basically this act says that indexation will be available only from the date of acquisition by the SSC, from the period of acquisition by the SSC. Okay, so if we strictly follow the act, indexation will be obtained only from 2022-23 because that was the year in which that was purchased by Aryan Khan. Aryan Khan got this asset only 2022-23. So strictly if we go by the provisions of this act says that you can take indexation only from 2022-23. But there has been several case laws where people had been asking, when you take previous honest cost, when you take previous honest period, why not the indexation also? Indexation also shall be obtained from the period of previous honor. I should get indexation from 2004-5. Since I'm taking cost of 2004-5, I'm taking period of 2004-5, my indexation shall also start from 2004-5. Hence, there had been certain case laws, and based upon that case law, we can give indexation from 2004-5, and the case law is CIT versus Manjula J. Shah, that was a Delhi High Court decision, and Arun Shimlu Trust versus CIT, the Bombay High Court decision. In these two High Court decisions, it's not a Supreme Court decision, mind you, there is a High Court decision. In these two High Court decisions, it have been held that where you are taking previous honors cost, where you're taking previous honors period, you can take indexation also from previous honor. And all the problems in the ICAI study material, have been answered by following this case law. So what does that mean? While computing capital gain, you have to take previous honors indexation, but you have to mention this case law in your answer. Please mention this case law in this answer. So from now on, in your journey in capital gain, Manjula J. Shah and Arun Shimlu Trust will be with you. Okay, in our journey of capital gain, we have to continuously keep on thinking about Manjula J. Shah and Arun Shimlu Trust, because this is that one case law which says that where you are taking previous honors cost, you are taking previous honors period, then why not indexation? Indexation also from previous honor. Now, so that was the first point. We have to take previous honors cost as our cost. And when this section is applicable, as it is acquired by a transaction which is not transfer. Example give. Then I take previous honors cost. Period of holding of previous honors also added to the period of holding of SSC. Improvement expense of previous honor will also be claimed as deduction by the SSC, which means Aryan Khan can claim deduction for improvement of Shah Rukh Khan. So Shah Rukh Khan's improvement is also taken by Aryan Khan. Aryan Khan definitely can claim deduction for his own improvement. And also he can claim deduction for everything we can take of previous honor. Everything, cost of purchase, cost of improvement, period. Then why not indexation alone? So that is the reason why this case law has happened. This decision has happened. CIT versus Manjula J. Shah and Arun Shimlu Trust. Both the case laws have decided in favor of SSC, which says indexation can be taken from the date of previous honor. So that is section 49(1) regarding notional cost of acquisition. Okay, cost of previous honor. Now let us come to point number 2. Point number 2, where we look into previous honors cost. Point number 2, where we look at not previous honor, something else, notional cost. Something other than my actual cost is taken as my cost. That is what is called as notional cost. Okay, not actual cost. Anything else is taken. Now, what is the second case? Let's take an example. Like, what shall be the example? Indira Gandhi, our earlier Prime Minister, she purchased a property in 1975-76. Okay, she died, and then the property was inherited by Rajiv Gandhi. Inheritance Inheritance is also a transaction which is not transfer. This was inherited by Rajiv Gandhi upon death of Indira Gandhi, and I think that happened in 84-85. So Rajiv Gandhi died, and this Indira Gandhi died, and the property that was inherited by Rajiv Gandhi. Rajiv Gandhi died, and then the property was transferred to Sonia Gandhi. I think that was in 1996-97. Rajiv Gandhi died. So that was inherited by Sonia Gandhi. Now what happened is, Sonia Gandhi gifted this property to Rahul Gandhi. This property was gifted to Rahul Gandhi in 2002-3. This property was gifted to Rahul Gandhi in 2002-3. Let us take 22-23. Not 2002-3, let us take 22-23. And finally, in 2023-24, Rahul Gandhi sells this property. So there has been a lot of gift and inheritances earlier. Okay, he is selling this property for again 5 crore. Indira Gandhi purchased this property in 1975-76 for an amount of 5,000. That was the value for which Indira Gandhi had purchased this property, right? Then Rajiv Gandhi acquired this for 0 value. Sonia Gandhi also acquired this for 0 value. Rahul Gandhi also acquired this for 0 value. And finally, Rahul Gandhi is selling this property for 5 crore. We know that sale consideration of Rahul Gandhi. We are calculating capital gain of Rahul Gandhi. None of the other persons in this example need to pay tax because gift or inheritance is not transfer. So no other person in this example need to pay tax. Only Rahul Gandhi has to pay tax. So we have discussed in 49.1 that, the earlier section that, 49.1. When a property is received by gift, you have to take previous owner's cost. So Rahul Gandhi will take Sonia Gandhi's cost. But Sonia Gandhi has also acquired it by gift. So Sonia Gandhi's cost is Rajiv Gandhi's cost. Rajiv Gandhi has also acquired it by way of gift or inheritance. So Rajiv Gandhi's cost is Indira Gandhi's cost. So ultimately, Rahul Gandhi's cost is not Sonia Gandhi's cost. It is Indira Gandhi's cost. Meaning, when I tell you to take cost of previous owner, when I ask you to take cost of previous owner, I do not mean the immediate previous owner. It's not the immediate previous owner. If the immediate previous owner has also acquired by way of gift, you have to take that earlier previous owner. It's not just the immediate behind person. You understand? It's not that person immediately behind me, immediately previous to me. If the immediate person has also taken it as gift, take the person above that, and so on. So a person who has acquired it by a transaction which is actually transfer, his cost will be taken by this person. So ultimately now, Indira Gandhi's cost will be taken as Rahul Gandhi's cost. Okay, so 5,000 will be taken as Rahul Gandhi's cost. Now let us come to the next section. 55.2. 55.2 says that your cost is higher of actual cost or fair market value as on 1/4/2001. Actual cost or fair market value as on 1/4/2001. So in the same example, let me assume that fair market value on 1/4/2001 is, fair market value on 1/4/2001 is, fair market value is, let us take 2 lakhs. Fair market value as on 1/4/2001 is 2 lakh. You may choose your cost as it's actually an optional value. So we will choose when the actual cost is higher, because if the actual cost is higher, profit will be lower. So you can choose either actual cost of 5,000 or fair market value 2 lakh. whichever is higher as your actual cost. So in this case, even 5,000 Indira Gandhi's cost is not taken as Rahul Gandhi's cost. We take 2 lakh as cost of acquisition of Rahul Gandhi. So when this section is applicable, when can we apply this rule? So we are given an option. We are given an option to choose either actual cost or fair market value as on 1/4/2001, whichever is higher. But when can this rule be applied? When this section is applicable, okay? This section is applicable when this asset is acquired by the SSE on before 1/4/2001. Asset is held by the SSE as on 1/4/2001. Before 1/4/2001, he is already holding the asset on 1/4/2001, meaning he has acquired it before 1/4/2001. Okay, he has acquired it before 1/4/2001. Before. Rahul Gandhi himself purchased the asset before 1/4/2001. Rahul Gandhi himself acquired the asset before 1/4/2001. That is point number 1. Then you can take fair market value as on 1/4/2001. In this example, if Rahul Gandhi has purchased this in 1975-76, Rahul Gandhi himself can take it as fair market value on 1/4/2001. Or the second case, this asset is acquired by previous owner. This asset is acquired by previous owner before 1/4/2001. Previous owner has acquired it before 1/4/2001, and I'm taking previous owner's cost as my cost under 49(1). Okay, I have acquired it only recently, but I'm taking previous owner's cost as my cost, and my previous owner has acquired it before 1/4/2001. Then also you can take either actual cost or fair market value. The example which I gave you now, that falls under point number 2, is it not? That falls under point number 2. Asset is acquired by previous owner, that is Indira Gandhi. We are taking Indira Gandhi's cost in this case. Indira Gandhi has acquired it before 1/4/2001, and that cost is now passed on to Rahul Gandhi. Then also Rahul Gandhi can take fair market value as on 1/4/2001. So these are the two cases where I can choose fair market value as on 1/4/2001 as my cost. One is I myself has acquired it before 1/4/2001. I acquired a property in 1985 HSS. My cost is FM. I can take fair market value if it is higher. Or my father has acquired it before 1/4/2001, and my father has gifted this property to me. I got this only in last year, but father has acquired it before 1/4/2001. Then also I can take fair market value as on 1/4/2001. Okay. Now another important point. Fair market value as on 1/4/2001, which you are taking, can never exceed stamp duty value on 1/4/2001. We all know that government has fixed the fair value in certain areas. So if the fair value as on 1/4/2001, the stamp duty value as on 1/4/2001 is available in that area, the amount which is chosen as fair market value can never go above the government valuation. The cost which you are accepting cannot go above the government valuation. You can take only the government value maximum as your cost. Let me explain this example. Let me explain this. In this case, we found that cost is 5,000. Actual cost of previous owner is 5,000. Fair market value on 1/4/2001 is fair market value as on 1/4/2001 is 3 lakhs. Okay. Stamp duty value as on 1/4/2001 is stamp duty value as on 1/4/2001 is 2 lakh. 2 lakh. Stamp duty value is 2 lakh. Now what shall be taken? What shall be taken as cost of acquisition? What shall be taken? Cost is 5,000. Fair market value as on 1/4/2001 is 3 lakh. Stamp duty value as on 1/4/2001 is 2 lakh. Okay. First of all, we have to compare these two. Compare these two, 5,000 and 3 lakh. And we have given an option to choose whichever is higher. We are given an option to choose whichever is higher. Okay. So we choose 3 lakh as that is a higher amount. As that is a higher amount, we choose 3 lakh. Okay. Then compare that 3 lakh with 2 lakh. Then compare that 3 lakh with 2 lakh, because as I told you, this fair market value cannot exceed stamp duty value. So you can take only the maximum of 2 lakh. Maximum of 2 lakh. You cannot take fair market value 3 lakh. Here the fair market value can be taken only at 2 lakh. So actual cost of acquisition in this case will be 2 lakh. You cannot take 3 lakh even though fair market value is 3 lakh. But the stamp duty value has been fixed only in respect of immovable property. So that rule regarding stamp duty valuation is applicable only for immovable property. For movable property, you can always take the market value, fair market value as on 1/4/2001. There is no restriction of stamp duty value. So that is over. The second case, will we take something else other than the actual cost as cost of acquisition? Second case is over. Now we come to the third case. Third case where we take something else other than actual cost as our cost of acquisition. Again, let me take an example. This is a depreciable asset. Depreciable asset, block of asset rule. Block of asset. Assets for which block of asset rule is applicable, they fall under this category. Okay, let us explain that. When we discuss business income, we categorized similar assets having same rate of depreciation into one block. Similar asset having same rate of depreciation, we had categorized to form one block, right? So let us group those assets together there. There are two assets, asset A and asset B. Together, their value is, I'm talking about written down value. Written down value is 3 lakh and 2 lakh. Okay. These assets were purchased long back and cost of asset A is, let us take 15 lakh. Okay. Cost of asset A is 15 lakh. And cost of asset B is, let us take 8 lakh. These were the actual cost for which they were purchased, but they have been depreciated over a period of time. And now their written down value is 3 lakh and 2 lakh. Let us assume that A was purchased in 2019-20 and B was purchased in 2021-22. These were the 2 years in which these assets were purchased. A purchased in 1920 for 15 lakh and B purchased in 21-22 for 8 lakh. They have been depreciated over a period. And now their opening written down value is 3 lakh and 2 lakh. Let us group them together to form a block. So opening written down value of this block is, 5 lakh. Okay, opening written down value. We have purchased one more asset, that is asset C to this block. Plan C to this block has been purchased. Plan C is purchased for an amount of 4 lakh. Plan C is purchased for 4 lakh. So total, now this comes to 9 lakh. 9 lakh. I am selling one asset in this block. Plant A is sold. Only one asset is sold for 12 lakhs. Okay, one plant is sold for 12 lakhs. Now the closing written down value is, minus 3 lakh. We had explained in business income that in order to charge depreciation, there are two conditions to be satisfied. Condition number 1 is that the block should have a positive written down value. Only if the block has a written down value, we can charge depreciation. Here the block has no written down value, so depreciation will be 0. Okay, depreciation will be 0. We cannot charge depreciation. Then what will this 3 lakh be called as? 3 lakh will be called as, if there is no depreciation, we call this as capital gain. Capital gain is 3 lakh. There is no depreciation. We have to charge capital gain. Capital gain now becomes 3 lakh. If you are computing capital gain, our format is different. We cannot write the format in this way. We have to start with sale consideration. Is it not? Sale consideration. So let me reverse the format. Upside down. Let me reverse the format. Sale consideration. I'm computing for a block, you know. Sale consideration is 12 lakhs. Sale consideration is 12 lakh. From this, I have to deduct cost of acquisition. Cost of acquisition. See, what was deducted? We know that here the capital gain is 3 lakh. Is it not? We have got capital gain as 3 lakh. In order to arrive at capital gain of 3 lakh, we have deducted 9 lakh. We have deducted 9 lakh. Now, what does this 9 lakh represent? 9 lakh represent opening written down value plus additions. 9 lakh is equal to opening written down value plus additions. We did not look into the actual cost of these assets. Actual cost of these assets were 15 lakh and 8 lakh. But we did not consider that actual cost of 15 lakh and 8 lakh in order to compute capital gain. Instead, what we considered opening written down value. Instead of actual cost, we looked into opening written down value of those assets. Plus, of course, any new assets purchased in the same year was also added. Any new asset purchased in the same year was also added. What does that mean? For depreciable asset, actual cost is opening written down value plus additions. We did not consider 15 and 8. We did not consider 15 and 8. For depreciable asset, actual cost is opening written down value plus additions. Opening written down value of 5 lakh plus addition of 4 lakh. That is what is taken as cost of depreciable asset. So let us see. What is taken as notional cost? Notional cost is opening written down value plus additions to the block during the same year. When do we apply this rule? To whom this rule is applicable? This rule is applicable to depreciable assets. This rule is applicable to depreciable assets. Okay. Now, one important point. There is no indexation. Depreciable assets, we never index. Depreciable assets, there is no indexation possible. Because we are considering the opening written down value, the value as in 1/4/2023. We are not looking into the value of 2001. What is the point in indexation then? We are considering only the value on 1/4/2023. So there is no indexation. And another important point, capital gain is always short-term capital gain, irrespective of the period of holding. Irrespective of the period of holding. You see, asset A was purchased in 1920, asset B was purchased in 21-22. There will be different assets in the block, various assets being purchased in various financial years. So we are computing only for a group. So we will ignore the period. We will by default call capital gain of short-term capital gain of depreciable assets as short-term. By default, automatically, capital gain of depreciable asset is always short-term. So we had discussed earlier the cases where we cannot get indexation. We cannot get the indexation benefit. One, we all know it is short-term capital gain. Second, I had explained depreciable asset. Depreciable asset is one case where we cannot get indexation. But where we cannot get indexation. Yes, that is the third case. Depreciable asset, the cost is opening written down value plus additions. There is no indexation, and the capital gain shall always be called as short-term capital gain. Ignore the period of holding. Need not consider the period of holding because there are various assets in that block, different assets having purchased on different years. And for the time being, I'll calculate only one more item here, one more item in this case, one more item of notional cost, one more item. Okay. What is that? This is regarding advance money forfeited. Advance money forfeited. This point is regarding advance money forfeited. Forfeited means which is never refunded. You know share application money forfeited, which means the company does not give back, refund. Company does not refund that share application money. Similarly, this is advance money. Let me explain this. In 2005-6, you purchased a property for 50,000. Okay, you purchased a property for 50,000. That is the cost of acquisition. Let's make it 5 lakh. Instead of 50,000, let us make it 5 lakh. Let us add one more zero there. 2012-13. 2012-13. This is purchase, right? This is purchase. 2012-13. There was some negotiation for transfer of the property. Some negotiation for transfer of the property. Some talks about selling the property. There was some negotiation. You took an advance. You decided to sell this property. You took an advance. An advance of 1 lakh was taken in 2012-13. But the sale did not happen. Transfer did not happen. The agreement between you and the prospective buyer, that did not happen. The buyer, he approached and cancelled the agreement. Buyer approached and he cancelled the agreement. He said that he is not interested in the property. He is not interested in the property. He withdrew from the agreement. See, the buyer withdrew from the agreement. And since the buyer withdrew from the agreement, this 1 lakh was not refunded. Since it was buyer's fault, you did not refund it. If it is seller's fault, you have to refund. But here this is buyer's fault and hence that is not refunded. That is what is called as forfeiture. Advance money is forfeited now. In 2012-13, advance money is forfeited. Now, let us think of the section. 2012-13, you have held a property. There is no transfer. You have not withdrawn any right in your property, which means there is no exchange, there is no sale, there is no relinquishment, there is no extinguishment. Nothing has happened. So there is no amount, no tax payable in 2012-13, even though you have received an amount of 1 lakh. On that 1 lakh amount received in 2012-13, there is no capital gain because there is no transfer that has happened. There is no exchange. There is no relinquishment. There is no extinguishment. Nothing has happened. Relinquishment has happened for the buyer, not for the seller. You are the seller here, right? You are the seller here. So nothing has happened for you. You received an amount of 1 lakh, but there is not transfer, hence there is no tax payable. Now in 2023-24, you are actually selling this property. You are actually selling this property for an amount of 50 lakhs. Okay, so let us compute capital gain now. In 2023-24, we are computing capital gain. When we compute capital gain, we have to start with sale consideration. We have to start with sale consideration. Sale consideration is 50 lakhs. Okay. Now this is a long-term asset, so we have to index it. Index cost of acquisition. Now index cost of acquisition, when we take the cost of acquisition, cost is not taken as 5 lakh. Cost is not taken as 5 lakh. Instead, 1 lakh will be deducted from cost of acquisition. One lakh will be deducted from cost of acquisition. In other words, the advance money which was not taxed in 12-13 is now taxed. Advance money which was not taxed, advance money forfeited which was not taxed in 12-13 is brought into taxation when the property is subsequently sold. How do you bring that into taxation? We deduct that advance money from actual cost. We deduct advance money from actual cost. Then the actual cost decreases, profit increases. So advance money forfeited is not taxable in the year of forfeiture. Instead, it is taxable in the year in which that property is subsequently sold. And in that year, that advance money forfeited will be deducted from cost of acquisition of property. So 4 lakh has to be indexed now. 4 lakh. See, we are taking 4 lakh as cost of acquisition instead of actual cost of 5 lakh. CII for 2023-24 divided by CII for 2005-6. This is how we compute. This is how we compute. Okay. So that is the next case where we consider something else as our actual cost. We are not taking 5 lakh as our actual cost. We are taking 4 lakh as our actual cost. And how that became 4 lakh? Any advance money which is forfeited earlier, will be deducted from cost of acquisition when that property is subsequently sold. So cost of acquisition gets reduced. It's not the actual cost. See, but that was the rule before 1/4/2014. If any advance money, so let us read that rule. What is taken as notional cost? Amount taken as notional cost is actual cost minus advance money forfeited. Advance money forfeited by previous owner will not be, however, deducted, even though you are taking previous owner's cost. In the example which we told earlier, where Shah Rukh Khan gifted a property to Aryan Khan, Shah Rukh Khan has forfeited any advance money that will not be deducted by Aryan Khan. Okay. Now, when this rule is applicable, when this advance money is deducted from actual cost, advance money received and forfeited by SSC before 1/4/2014. Before 1/4/2014, we have to tax it under capital gains. Advance money forfeited will be automatically taxed under capital gains. But after 1/4/2014, what happens is, if the same advance money had been forfeited, let me continue this example. If the same advance money had been forfeited in 2018-19, what will be the rule? 1 lakh will be immediately taxable. That is, it will be taxable in the same year. Under income from other sources. In the same year under income from other sources. Okay. If the forfeiture happens, if the advance money is forfeited after 1/4/2014, taxation is under IFOS. After 1/4/2014. If advance money is forfeited before 1/4/2014, then the taxation is under capital gain. Advance money forfeiture, there are two rules. Before 1/4/2014, capital gain. After 1/4/2014, you pay tax immediately. Other sources, you have to pay it as taxation. You have to pay it as tax. Okay, immediately we will pay tax under 1/4/2014. After 1/4/2014, it is IFOS. We pay tax immediately on 1 lakh. So since we have already paid tax on 1 lakh, 5 lakh itself will be taken as cost of acquisition. So this section of capital gain, section 51, is applicable only if advance money is forfeited before 1/4/2014. After 1/4/2014, we directly go to other sources and tax it immediately under that head. Okay, so these are the 4 cases where we consider something else other than the actual cost. That is a notional cost as our cost of acquisition. First one is cost to previous owner in case of transactions called gift. Second one is fair market value as on 1/4/2001 can be taken if it is higher than actual cost, but again cannot go above stamp duty value. Third point is opening return down value plus additions for depreciable asset. And point number 4, advance money forfeited will be deducted from cost of acquisition if advance money is forfeited before 1/4/2014. Point number 5 and 6 we'll discuss later. Now we'll come to computation of capital gain under special situations. There are around 22 special situations for determination of capital gain under special cases. There are around 22 special cases. For the time being, we'll discuss, since this is a revision, fast track revision, I will explain the important items, around 3 to 4 items, I think, the important ones. One is this conversion of capital asset into stock in trade. Second one is the slum sale. Then there is one section called 50C. These are a few items which are very much important, and we will discuss these 3 cases first. If time permits, we'll discuss the other 19 cases. Okay. So the first case is computation of capital gain in special case. The first case is conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. Again, let us explain with an example. 2004-5, I purchased a land. 2004-5, I purchased a land. The land was purchased for 2 lakhs. In 2021-22, what happened is I commenced real estate business. So I brought my land, the land which is with me, to business as my stock in trade. I brought land to my business as stock in trade in 2021-22. Generally, if somebody that is a proprietor of the business, he brings in cash, we record the journal entry, cash account debted to capital. If someone brings in cash to the business, if the proprietor brings cash to the business, we record the journal entry, cash account debted to capital. But here I brought stock to the business. I brought stock into the business. My capital asset has been converted into stock. So I recorded a journal entry, purchases account debtor to capital. Purchases account debtor to capital. This was the amount for which, this was the journal entry which I had recorded. And I recorded this at, let us take 10 lakh. 10 lakh. But the fair market value as on that date was only 8 lakhs. Fair market value was only 8 lakh, but I just put it 10 lakh. In my books, it is my books, it's my stock, it's my capital asset, everything belongs to mine. So I recorded 10 lakh. Okay. Now, we have found in the definition of transfer that, conversion of capital asset into stock in trade is transfer. Conversion of capital asset into stock in trade is transfer. So there is a transfer which has happened in 2021-22. There is a transfer that has happened in 2021-22. But alas, but the problem is, I have not received any money in 2021-22. I just recorded a journal entry, purchases account debtor to capital. Income tax department says you have made transfer, but I have not received any money. Without getting money, how can I pay tax? How can I pay tax? I have no money. I recorded only journal entry, purchases account debtor to capital. Okay. 2023-24, I sold this land from business. From business, I sold this land. Okay, I sold this land from business for an amount of, let us say, 15 lakhs. That is the point when I receive cash. That is the time I don't receive any money in 2021-22. So this section has been introduced for the benefit of SSC. This section has been introduced for this benefit of SSC. 45.2 section, the special rule. What is the special rule regarding capital gain? The special rule is you need to pay tax only in the year in which stock is sold from business. That is the speciality about this section. Even though the transfer has happened in 21-22, since you have not received any money, you need not compute capital gain in 21-22. Meaning the capital gain has happened, the taxation, the transfer, everything has happened, but it will be included to your income of only 2023-24. The transfer of 21-22 will be included to your income only in 23-24. The transfer that has happened in 21-22 will be included in your income only in 23-24. So in 2023-24, we are computing first capital gain. What is sale consideration? What is sale consideration in 21-22? See, the fair market value. I don't look into the value which you have recorded in books of accounts. No, I don't trust that. I don't trust your value. asset, the fair market value is only 8 lakh, then the capital gain sale consideration would be taken as 8 lakh. So the value at which you have recorded it, I don't trust that. We will take fair market value as on the date of transfer. That is 21-22 fair market value, 8 lakh will be taken as sale consideration. From that, we will deduct cost of acquisition. Cost of acquisition is 2 lakh into. Let us think about that formula. CII for the year of transfer. CII for the year of transfer, which is this year of transfer, 2021-22. So you can multiply only by CII of 21-22. You cannot multiply by 2023-24. This has been introduced just for the sake of the SSC that he has not received money. Transfer has actually happened in 21-22. So indexation benefit you can claim only up to 21-22, even though you are making this calculation in 23-24. Okay, even though the calculations made in 2023-24, always we multiply by the CII for the year of transfer. Year of transfer is 21-22. You have to carefully keep in mind this point. Indexation is never obtained up to 23-24. You can get it only up to the year of transfer. So multiply by this year of transfer. Then divide by CII for the year of purchase. That is CII for year of purchases 2004-5. Compute capital gain. Compute capital gain. In 2023-24, we have another income also. What is another income? And also business income. You have sold a stock in this year, so you have business income. Business income, sale value is, you have sold this for 15 lakh. And what is your cost taken for business? For business, the cost will be 8 lakh. See, 8 lakh. The cost will be 8 lakh. Why? Profit up to 8 lakh. Difference between 2 lakh and 8 lakh. Difference between 2 lakh and 8 lakh has already been taxed as capital gain. Is it not? This has already been taxed as capital gain. Profit from 2 lakh to 8 lakh has already been taxed as capital gain. So the amount to be taxed under the head businesses only. The amount to be taxed under the head business is only the difference between 15 lakh and 8 lakh. Okay, the difference between 15 lakh and 8 lakh will be taxed as business income. In other words, sale consideration of capital gain will be taxed as cost of acquisition of, will be taken as cost of acquisition of business. Sale consideration of 8 lakh will be taken as cost of business. Do you understand? Sale consideration of capital gain will be taken as cost of business. Cost of business. This is taken as cost of business. The reason is difference between 2 lakh, the total profit which this person has made is between 2 and 15 lakh, right? It was purchased in 2 lakh. Finally, it was sold in 15 lakh. In between, that has been converted into stock in trade. So this conversion part we tax under capital gain. 2 to 8 lakh we tax under capital gain. 8 and 15 we tax as business income. So when the stock is sold, you have two incomes that happen simultaneously. That is why I have given the picture of twins there. Twins. When stock is sold, two things come together. What are the two things that come together? There is business income, there is capital gain. Do you understand? Till the point stock is sold, you need not pay any tax. Till the point stock is sold, no taxation. But once stock is sold, two things come together. One is capital gain and the other is business. Okay, so let us read that. This special rule is applicable when conversion of capital asset happens into stock in trade. Year of taxation is a year in which stock is sold. But in that year, there are two incomes, that is twin income. There are twin incomes. Okay, twin income. One is Fair market value minus cost or index cost, as the case may be, will be taken as long-term or short-term capital gain. And sale value minus sale value of stock minus fair market value will be treated as business income. Both happen in the year of 2023-24, but keep in mind, indexation is applicable only up to 21-22, which is the year of transfer. The only thing is, transfer that has happened in 21-22 is added to your income of 23-24. So what calculation you make in 21-22, make all those calculations, but include that amount only in 2023-24's income. Because you receive cash only in 23-24, you pay tax only in 23-24. Okay. We have problems from this part. That is usually asked for exam. We'll take a short break. We'll take half an hour break and we will join. Okay. in the stock in trade. Let me check the earlier RTPs and MTPs. This question, we will do a question from the study material. Let me check the earlier RTPs and MTPs. There is no question in the RTP, MTP relating to that. So we'll do a question from the study material, ICAI study material, which contains a question on the topic. Conversion of capital asset in stock in trade, we have to do a lot of calculations in respect of that. We'll first compute capital gain. There are chances that a student might go wrong because CII, you have to be very careful up to which year you have taken CII. So all these points being important, we'll do one question from that. This is a question from ICAI study material. Harshida purchased a land. Harshida purchased a land at a cost of 35 lakhs in financial year 2004-5. And he held the same as her capital asset. She held the same as her capital asset till 20th March 23. She started real estate business on 21st March 23 and converted all these land into stock in trade of the business when the fair market value was 210 lakhs. Okay, so fair market value was and the date of conversion is also given. She constructed 15 flats of equal size. She constructed 15 flats of equal size. All right. 15 flats of equal size has been constructed. Cost of construction of each flat is 10 lakh. Construction was completed in, there is a correction here. Construction is completed in February 24, March 24. So she constructed 15 flats of equal size and quality, everything to, similar. Cost of construction of each flat is 10 lakh. Cost of construction was completed in February 24. She sold only 10 flats. Constructed 15, but could sell only 10 flats. Remaining 5 flats is held as stock in trade. She invested 50 lakhs in bonds issued by National Highway Authority of India and Rural Electrification Corporation. This we'll discuss later. This portion, let us keep it in pending, because this is what we are going to discuss later regarding exemption from capital gain. So we are doing only these 2 paragraphs. For the time being, we are doing only these 2 paragraphs relating to conversion of capital asset into stock in trade. 15 flats were constructed, of which only 10 flats were sold. So we can compute capital gain. We need to compute capital gain only for 10 flats. We need to compute capital gain only for 10 flats. We cannot compute capital gain for 15 flats. Capital gain shall be computed only for 10 flats. Okay. That means what proportion of total land is sold? What proportion? 10 by 15. 10 by 15 means 2 by 3. Only 2 by 3 is sold, is it not? So everything we have to calculate proportionately only for 2 by 3. Capital gain has to be computed only for 2 by 3. So also business income is also to be computed only in the ratio 2 by 3. Only in the ratio 2 by 3 because we have sold only 2 by 3 of total flats. Okay, only if you sell, you need to pay capital gain. You have sold only 10 out of 15. You have sold only 10 out of 50. So we compute capital gain only for 10 flats. All right. So all cost, all fair market value, everything I take in the ratio 2 by 3. So let me first compute capital gain. Before that, let me mention some points here. Which is the year of transfer? Which is the year of transfer? Year of transfer is Conversion date. The conversion. Conversion date is 2022-23. Year of purchase. Year of purchase. Year of purchase is purchased a land of cost 2004-5. 2004-5. Now, year of sale of stock in trade is year of sale of stock in trade is 2023-24. Year of sale of stock in trade is 2023-24. This is how we are going to compute. Now, these are the various data which we have gathered. Year of purchase is 2004-5. Year of transfer is 2022-23. Year of sale of stock is 2023-24. Okay. Now, only 10 flats have been sold. 10 out of 15 is sold. Out of 15 is sold. Only 10 flats are sold. How to compute capital gain? How to compute capital gain? The fair market value as on this date is, fair market value as on the date is 210. But this 210 is for the whole. 210 is for the whole amount. So when we compute capital gain, we are first computing capital gain. What shall be treated as sale consideration? What shall be treated as sale consideration? Sale consideration is fair market value, but only 2/3 of fair market value need to be taken. 2/3 of fair market value. That is 210 lakh into 2 divided by 3. 210 lakh into 2 divided by 3, which is equal to 1 crore 40 lakhs. We are now computing capital gain of all 2/3 portions. Okay. Cost of acquisition also, when we consider, we take only 2/3. But this is an index cost because as it is long term, we have to take the index cost of acquisition. So let us deduct indexed cost of acquisition. Index cost of acquisition. Index cost of acquisition is you have purchased this for 35 lakh. All right. 35 lakh is for the entire thing. 35 lakh. Cost of 35 is for the entire thing, for the whole. We take only 2/3. We take only 2/3. So 35 lakhs into 2 divided by 3 into CII for which year? CII for which year? CII for 2022-23 divided by CII for 2004-5. CII for 2022-23 divided by CII for 2004-5. This is how we have to compute. Okay, 2023 is a year of transfer, so indexation is available only up to 2022-23. So how do we calculate that? 35 lakh into, let us see what is CII for 2022-23. CII for 2022-23 is 331. 331. 22-23 is a year of conversion? Yes. So 331 divided by 2004-5, the CII is 113. 4-5 is a year of purchase, there the CII is 113. So 35 lakhs into 2 divided by 3 into 331 divided by 113. 35 lakhs into 2/3 into 331 divided by 113. Okay. So it comes to, this is the index cost of acquisition. This is the index cost of acquisition. I think no other expenses. So we have completed this first paragraph. 210 we have taken, 35 lakhs, everything proportionate we have taken. Okay. The land has been converted. Land has been brought into stock. Land has been converted. This is the capital gain, and this will be long-term capital gain. long-term capital gain. Okay, apart from this, we have another income during this year, that is profits and gains of business and profession. Apart from this, there is another income, profits and gains of business or profession. All right. So let us see what is capital gain, what is profits and gains. The sale value of 10 flats. We will take only sale value of 10 flats. Sale value of 10 flats is 10 into 30 lakhs. 10 into 30 lakhs. 10 into 30 lakhs come to 3 crore. Okay. Less purchase cost. Less purchase cost. Purchase cost is this 1 crore 40 lakh will become purchase cost. 1 crore 40 lakh. There is one more expense, that is business expense. Business expense means after this has been converted into stock in trade. See, anything which we incur on this asset between 2004-5 and 2022-23, if the expense is incurred till that is converted into stock in trade, when that asset was capital asset in my hands and I have incurred expenses on that, it will be allowed as reduction under the head capital gain. It will be called as improvement expense and will be allowed as reduction under the head capital gain itself. Okay, any expenditure which is incurred on this land between 2004-5 and 2022-23 is called as capital expenditure, and that will be claimed as reduction as improvement expense under the head capital gain. Any expenditure after it has been converted as stock in trade will be called as business expense, because then you are incurring the expenditure upon your stock. So expenditure is incurred upon stock in trade after 22-23, then that will be called as business expense. So business expense is cost of construction of these flats. Cost of construction of these flats is 15 flats into 10 lakh. 1 crore 50 lakh. After deducting all these, the balance which you get, that is called as business income. The balance which you get is called as business income. Okay. So this will be your total income for assessment year 24-25. This will be your total income. Total income for assessment year 24-25. Yes, this is a format for computation of capital gain and also format for computation of business income. So this is how we calculate. First of all, find out what is fair market value as on the date of conversion. That will be taken as sale consideration. But the capital gain so computed will be taxable only in the year in which stock is sold. So when the year is in the year in which the stock is sold, there will be two incomes coming together. One is business income and other one is capital gain. We have completed this. Now let us continue with the special situations. What are the special situations? Let me explain one more special situation, that is regarding compulsory acquisition of asset, because the logic in situation 1 and situation 2 is almost similar. The logic which we are discussing in situation 1 and situation 2 is almost similar. The logic being that is when an asset is compulsorily acquired by the government, the problem regarding government acquisition is that asset may be taken by the government, but money will be received only in the later year. Money will be received only in a later year. So without receiving money, we cannot pay capital gains tax. Without receiving money, we are not able to pay capital gains tax. So the capital gain, even if the property has been acquired by the government, tax will be payable only in that financial year in which you receive at least a part of the compensation. Tax will be payable only in that financial year in which at least a part of the compensation is first received. Part of the compensation is first received. That is the previous year in which tax is to be paid. Okay. So compulsory acquisition of capital asset is taxable, but not in the year in which asset is taken away by the government, but in the year in which money is received. Even if only part of the money is received, you have to compute capital gain the entire sale consideration. Right? What do I mean by that? A property was acquired by the government. Compulsory acquisition happened in 2022-23. Okay. Total compensation fixed is 5 lakh. Total compensation received fixed is 5 lakh. 1 lakh received in 2023-24 and 4 lakh received in 2024-25. Okay. 1 lakh received in total value is 5 lakh, of which 1 lakh is received in financial year 23-24 and 4 lakh is received in 24-25. Now, taxation arises. This is the year of taxation. You need to pay tax only in 2023-24 because that is the time when money was received. But even when you receive only 1 lakh, you have to pay tax on the entire 5 lakh. You have received only 1 lakh, but you have to pay tax on the entire amount of 5 lakh because the 1 lakh received will be sufficient to pay your taxes. See, when we compute taxes, we have to deduct interest, cost of acquisition, then we are applying the rate and all. So that 1 lakh will be sufficient to meet the tax element part. So they say, even if only a part of the compensation is received, the 5 lakh received will be taxable. 5 lakh received will be taxable in the year in which that part of the compensation is received. So that is the year in which you have to tax it. Indexation is available only up to the year of compulsory acquisition. No doubt about that. Indexation you can claim only up to 22-23 because that is a year of transfer. So even though you are calculating in 23-24, you multiply by CII of only 2022-23, the way we have done in this question. Enhanced compensation. Many cases, when there is compulsory acquisition, the person who received the money, he may not be satisfied with the amount of compensation received. He may not be satisfied. Many cases, they are dissatisfied with the amount of compensation which is fixed by government. So what they do is, they file a case. They file a case for receipt of enhanced compensation. Enhanced compensation will be taxable in the year of receipt. Whenever later when you receive enhanced compensation, that year you have to pay taxes. And you cannot claim cost of acquisition and cost of improvement as deduction from enhanced compensation because both cost of acquisition and cost of improvement has already been deducted from the original compensation. Both cost of acquisition and cost of improvement has been deducted from the original compensation. So when you receive enhanced compensation is fully taxable. Enhanced compensation is fully taxable, but we can claim one item as deduction. That is litigation expenditure. The litigation expenditure cases, if you have filed, that will be allowed as deduction. All right. Then enhanced compensation is received by some other person on the death of SSC. The original SSC dies. By the time the verdict comes, the verdict of the court comes for granting of enhanced compensation, the original SSC has died. It will be received by the legal heir. It will be taxable in the hands of legal heir. That is regarding enhanced compensation. I don't think we have any problems from that. Now, the case which I'm going to discuss next is slum sale. Slum sale. There are a lot of questions that have been asked for exam. I think in the RTP MTPs, I have around 2 to 3 questions in the earlier RTPs and MTPs. Around 2 to 3 questions. We'll see that. From slum sale, there are, yes, this is one question. RTP May 22, there is a question on slum sale. We'll see what are the rules regarding that. Section 50B is the section that governs with the provisions of slum sale. Okay. Slum sale, no doubt, the amount of taxation arises in the year of transfer. But what do you mean by slum sale first? Slum sale means an organization is sold for a lump sum consideration. An organization as a whole is sold for a lump sum consideration without assigning value for each and every individual item. Let me explain that. I'm doing business. I'm doing business. I purchased land for 5 lakh. I purchased building for 2 lakh. I purchased furniture for 3 lakh. Various years. See, land was purchased in 2002-3. Building was constructed in 2004-5. Furniture was purchased in, let us take 2022-23 or 23-24, whatever. And like this, I have been doing business here. I purchased a land. I constructed a building. I'm doing business now here. Okay, furniture. Or this is my personal asset. I'm staying in this property. Can be a personal asset as well. Let us take this as a business organization. This is a business organization. I purchased land. I constructed building. I purchased furniture. Everything I have done. And now what I'm planning to do is I have decided to sell all these together. All this together. This land plus building plus furniture. Everything together is sold for a lump sum consideration of 2 crore. Everything together is sold for a lump sum consideration of 2 crore. Land plus building plus furniture. Everything together. I'm selling for 2 crore. Okay. I do not know what is sale value of land. No, that is not separately available. Sale value of land, I have no information. Sale value of land, I have no information. What is sale value of building? No information. What is sale value of furniture? No information. Everything together I'm selling for 2 crore. Everything together. Land plus building plus furniture. Even though these are purchased on different dates. Everything added together and I'm selling. How to compute cost of acquisition in this case? In this case, what I deduct as cost of acquisition is, okay, cost of acquisition is equal to net worth. Cost of acquisition is equal to net worth. Net worth is deducted as cost of acquisition. That is what is called as cost of acquisition in this case. And what is net worth? How do you compute net worth? Net worth is equal to asset minus liability. Asset minus liability. We all know that in from accountancy, we know that cost of acquisition is equal to asset minus liability. Okay. Now, asset means there will be fixed assets and current assets. Okay. There are fixed assets and current assets. Is it not? Fixed assets can again be divided into two. They are depreciable assets and non-depreciable assets. Depreciable assets and non-depreciable assets. Okay. Non-depreciable assets are the assets like land. Assets like land. If this land has been revalued for any reason, such revaluation changes are to be ignored. Revaluation changes are to be ignored. Okay, so any reason, mostly if that is a non-depreciable asset, what we generally do is we may revalue the asset, but that revaluation changes are to be ignored. Depreciable assets will be usually valued. Depreciable assets will be usually valued at their WDV as per income tax rules. When we compute net worth, how do we value assets and liabilities? That is what we are discussing right now. How do we value these assets and liabilities? Fixed assets are of two types. Fixed assets are of two types. The two types of fixed assets may be depreciable assets and non-depreciable assets. So depreciable assets, when you value, what you consider is, we have to consider WDV as per income tax rule. If non-depreciable asset like land is there, what we do is, we have to take only, we need not take the revaluation changes, we take the historical cost itself. So that is how we value the fixed assets. Then there are current assets. Fixed assets and current assets. Current assets will be usually taken at their book value. You know, the stock in trade, Then there will be the, what else? Stock in trade, current assets like debtors, cash in hand, cash at bank. Everything we will take at the book value. Add all these together. Add all these together. Now we have to deduct the liabilities. Liabilities. Liabilities again, what we consider as the book value. Deduct the book value. From these assets, deduct the book value. The balance is called as net worth. Balance is called as net worth. Okay, this is how we compute net worth. Net worth is taken as cost of acquisition. One more thing, there is no indexation benefit. There is no indexation benefit. So we had seen cases where the indexation benefit is not available. We have seen cases where indexation benefit is not available. One was short-term capital gain. The other one was depreciable asset. Now we have discussed the third case, which is a slum sale. Bonds and debentures also, there is no indexation. And this case is not usually asked. So these are the four cases which you have to keep in mind. Bonds and debentures, depreciable asset, and also slum sale. So this is how we compute net worth, deduct net worth. Now, one more thing. How about nature of capital gain? How do we take the nature of capital gain like? Is it short-term capital gain or long-term capital gain? What you have to consider is, if this organization as a whole, you take this organization as a whole, and this is in existence for more than 3 years, then the capital gain will be called as long-term. If this organization as a whole is in existence for more than 3 years, it will be called as long-term capital gain. Okay. Need not individually look into when the land was purchased, when the building was purchased, when the furniture was purchased. You need not individually look into all those things. See whether this factory building was here for more than 3 years. Fine, then this is long term. When the factory building is here for less than 3 years, then the capital gain will be called as short-term capital gain. Do you understand? So let us do an example like RTP question or MTP question from this. Mr. Aditya is a proprietor of Star Stores having 2 units. He has unit 1 and unit 2. On 1/4/23, he has transferred this unit for a slum sale by a total consideration of 18 lakh, 1/4/23. So just before that, we'll make a balance sheet. His balance sheet is as given. There was also expense on transfer. Okay. There are assets and liabilities. He is selling unit 2, right? Which unit he is selling? Unit 2. So we need to compute net worth of only unit 2. We need to compute net worth of only unit 2. Unit 1 is not to be considered. Agreed. Unit 1 is not to be considered for this purpose. Unit 2 will compute net worth. Land is having 7 lakh 50 value, furniture 5 lakh, debtors 3 lakh 50, patent 7 lakh 25. Here we have the liabilities. Liability column that is not given in 2 columns, but in a single column, but they have mentioned how much relates to unit 1 and unit 2. So we can take only the proportionate bank loan of unit 2, trade creditors of only unit 2, unsecured loan of unit 2. Now let's see what are the further information. Land of unit 2 was purchased for 5 lakh in the year 2004, and that was revalued to 7 lakh 50. See, the original cost of this land is only 5 lakh. Original cost of this land is only 5 lakh. This was revalued to 7 lakh 50. That is why there is a revaluation reserve of 2 lakh 50 here. There is a revaluation reserve of 2 lakh 50, but you have to consider, you have to ignore this. You need not consider this revaluation change. So land value will be taken only at 5 lakh. Land value will be taken only at 5 lakh. We won't take that 7 lakh 50 value because there is a revaluation change included in that. Okay, revaluation change which is included in that. 5 lakh, we'll take only 5 lakh. We don't take 7 lakh 50. No individual value of asset is considered in the transfer deed. Patents have been acquired on 1st December 21, on which no depreciation has been provided. Patent is an intangible asset. Intangible asset we have to depreciate. So they have not given any depreciation. Intangible assets are entitled for a depreciation of 25%. We have to look into all those things. Similarly, furniture which was purchased on 5 lakh on 1/12/22, on that asset also there was no depreciation. So this is also to be depreciated. 5 lakh also has to be depreciated. Debtors, no change. Fair market value of the asset transferred by way of slump sale is 18 lakh 10. You have the market value of asset transferred is 18 lakh 10, but you have taken only 18 lakh as your consideration. So what we have to do is, we will look into the fair market value. That is fair market value if it is higher. Fair market value of assets transferred in slump sale, if it is higher, then we will consider that value. We consider only fair market value. We won't consider that 18 lakh here. If fair market value of the assets transferred is not given in the question, see, you are transferring certain assets on slump sale. Its market value is 18 lakh 10. You are telling me that you are sold for only 18 lakh. How can I rely upon that? How can I rely upon your figure? Why do you transfer an asset worth 18 lakh 10 only for 18 lakh? You are lying. So what I will take here is fair market value of 18 lakh 10. So that is to be taken as sale consideration. So now let us compute slump sale. First we will write sale consideration. Sale consideration is 18 lakh 10,000. How does that come to? Actual sale value or fair market value, whichever is higher. Actual sale value or fair market value, whichever is higher, less cost of acquisition. What is taken as cost of acquisition? Cost of acquisition is equal to net worth. And net worth will compute in working note. Leave some space. Working note, computation of net worth. Computation of net worth. First, land. Brackets. Ignore revaluation changes. Ignore revaluation changes. So we take only 5 lakh. Furniture, it's 5 lakh, but we have to depreciate. Is it not? We have to find out what is the value as of now. As on 31st March 23. Is it not? 31st March 23. When was the furniture purchased on? Furniture. Cost on. When was the furniture purchased? It was December 22. Cost on 1st December 22 is 5 lakh. Less depreciation for 22-23. Only 1 year. Depreciation for 22-23. Original rate is 10%. But here we give only 50% because the furniture was used for less than 180 days. December 22. So 22-23, we have charged depreciation only for 50%. Okay. So 5 lakh into 5% will come to 25. Value of furniture is 4,75,000. Third item, debtors. Debtors, we take the book value. Debtors, we take the book value, 3,50,000. Patents, again, cost on 1st December 21. 1st December 21, the cost is 7,25,000. Less depreciation for 21-22. Depreciation for 21-22, it is 7,25,000 into 25% into 50% because used for less than 180 days. 21-22, it is used only for less than 180 days. So we can charge only half rate depreciation. 7,25,000 into 25% into 50%. Deduct that. From that, depreciation for 22-23. Depreciation for 22-23. Now we can charge 25% depreciation. This year we are charging 25% depreciation because it's used for the whole year. Now all assets are over. We have calculated depreciation, everything on all asset side. Asset side figures are taken. Now we'll come to the liability side and we will deduct only the proportionate liability of unit 2. Okay, proportionate liability of unit 2. We'll add all these assets together. Add these assets together. Less liabilities. Liabilities. There are 3 liabilities, but I'll take only the proportionate relating to unit 2. And 8,50,000 into 30%. 70% is relating to unit 1. 8,50,000 into 30 divided by 100. Trade creditors 4,50,000 into 20%. 4,50,000 into 20%. Unsecured loan 4 lakh into 30%. 4 lakh into 30%, is it? 4 lakh into 30%. Yes. Proportionately, we are taking only values of unit 2. So this is how we get net worth. This is the net worth of the organization. And we deduct that net worth from sale consideration. Cost of acquisition is over. Now we have to compute one more thing, that is expenses on transfer is also there, that is given in the question. Expense on transfer for sale of this asset is 78,000. 78,000. So that is also to be deducted. 3,96,219. Our next challenge is whether this is short term or long term. This is short term or long term. See, this unit 2 was started in 2004-5. Unit 2 was started in 2004-5. The capital gain will be taken as long term capital gain. Capital gain. 3,96,219 will be taken as long term capital gain. So this is how we compute capital gain in respect of slum sale. All right. Find out the net worth. While computing net worth, there are certain valuation rules. Certain changes are to be ignored. And after that, we'll compute long-term capital gain. Now, the next special case which we have to discuss is regarding 50C. Regarding 50C. 50C is similar to 43CA of business. 50C is similar to section 43CA of business. What does section 50C say? 50C. The stamp duty value of the property is to be considered. Stamp duty value. If stamp duty value of the property is higher than actual value, then stamp duty value will be taken as sale consideration. That is what section 50C, that C say the same point has been discussed in business under section 43CA. Both the sections are similar. The stamp duty value which is fixed by government in this area is 30 lakh. I'm selling the property for 25 lakh. 30 lakh will be taken as sale consideration. Minimum, you have to quote a sale consideration of stamp duty value. Minimum. If your actual sale value is more than stamp duty value, fine. Well and good. You can pay tax on that amount, but you cannot mention your sale consideration as lower than stamp duty value. But you may challenge stamp duty value in a court of law. you can see that the value which is fixed by government in this area is much higher than the market value and all that for some reason. In that case, you may challenge it in a court of law, and if this is challenged in a court of law, then the value adopted by court is treated as sale consideration. Value adopted by court is treated as sale consideration. Now, instead of challenging it before the court, if you move on to the valuation officer, a specific officer in Income Tax Act, if you approach him, then the value which is quoted by stamp duty, his valuation officer will be taken as stamp duty value. Either value taken by the valuation officer or actual stamp duty value, whichever is lower, will be taken as sale consideration. Now, there's a difference between stamp duty value as on the date of agreement and as on the date of registration. Which value would you take? You will take the stamp duty value as on the date of agreement. Let us take an example. I have explained all these in business as well, but again, stamp duty value on date of agreement is 20 lakhs. Stamp duty value on date of registration of the property is, registration happened, let us take 2 years later. By that time, stamp duty value had been revised to 22 lakh. Which would we take, 20 or 22? We can take the lower value of 20 lakhs, that the stamp duty value is on the date of agreement, provided two conditions are satisfied. Condition number 1 is advance has been paid. Advance has been paid on or before the date of agreement. On or before the date of agreement, advance has been paid. And second point is that advance is paid by account pay, check or draft. Advance is paid by account pay, check or draft. If these two conditions are satisfied, you can take 20 lakhs as the stamp duty value. Two conditions: advance has to be paid on or before the date of agreement, and such advance has been paid by account pay check. Then you can take stamp duty value of 20 lakh. Otherwise, we have to take 22 as the stamp duty value and compare that with your actual cost. Okay. Another point: if stamp duty value, there is variation between stamp duty value is not much. There is only a nominal variation between stamp duty value and your actual cost, and this provision can be ignored, which means you need not take stamp duty value. You can take the actual cost itself. And what is that percentage? A small variation which has been fixed is 10%. The stamp duty value does not exceed 110% of the consideration. Stamp duty value can be ignored. Like in this example, suppose actual sale value is 19 lakh. Actual sale value is 19 lakh. And I assume that these two conditions are satisfied. Advance has been paid. So the stamp duty value which I would consider is 20 lakhs. Now, what is the difference between sale consideration and stamp duty value? A difference of 10% is permitted, which means add 10% to 19 lakh. Add 10% to 19 lakh. 19 lakh plus 10% is 1.9 lakh, which is equal to 20.9 lakh. Okay. Only if the stamp duty value is about 20.9, you need to take stamp duty value. Only if the stamp duty value is about 20.9, we need to take stamp duty value. Otherwise, we need to take only actual sale value of 19 lakh. In this case, we have chosen the stamp duty value of 20 lakh. If the conditions are satisfied, stamp duty value of 20 lakh will be considered, and 20 lakh does not exceed 10% of the sale consideration. Hence, 20 lakh need not be considered. Here, sale consideration will be fixed at 19 lakh itself. On the other hand, if this advance had been paid in cash, if advance is paid in cash, if advance is paid in cash, I have to take the stamp duty value of 22 lakhs. Okay, 22 lakhs of stamp duty value will be taken. That is the stamp duty value which I have to compare. In that case, stamp duty value is 22 lakh. Actual sale value is 19. 19 plus 1.9 is equal to 20.9. Stamp duty value is greater than 20.9. So sale consideration will be 22 lakhs. Sale consideration is 22 lakhs. Here, Sale consideration we take is only, here sale consideration we take is only 19 lakhs. 19 lakh itself. Here we have to take 22 lakhs. So these are the two cases. Okay, this we have regularly, this provision will be tested in the exam. This provision will be regularly tested in the exam. First of all, let us do an MCQ question from this. First of all, we'll do an MCQ question. Question number 5. Question number 5. Let us see what is this question. A building was acquired on 1495 for 20 lakh. 1495, when you hear this before 1495, immediately you have to keep in mind that, this value is before 14-2001. So we always have an option to choose fair market value as on 14-2001. Since it is before 14-2001, we have an option to choose fair market value as on 14-2001. Okay, fair market value as on 14-2001 is 25 lakh. Fair market value as on 14-2001 is 25 lakh. But we have also advised that fair market value cannot exceed stamp duty value as on 14-2001. Do you remember that point? Fair market value shall not exceed stamp duty value as on 14-2001. Okay. Fair market value as on 14-2001 shall not exceed stamp duty value as on 14-2001. So here I cannot take fair market value. Here I cannot take fair market value. Fair market value is here not considered. Fair market value is not considered. Okay. This market value as on 14-2001 is not considered. Instead what we will consider? Instead of fair market value, what will be considered? We will consider, so let me put it in blue because that figure is not required. Instead, we will consider stamp duty value of 22 lakh. Compare stamp duty value of 22 lakh and actual cost, whichever is higher. So we will take cost as 22 lakh. So that is the first point. Fair market value is higher than stamp duty value. Fair market value is higher than stamp duty value. So stamp duty value is considered. Stamp duty value is 22 lakh. On 1/4/2001, actual cost is 20 lakh. So cost of acquisition will be 22 lakhs. This cost of acquisition. Now let us think about the sale consideration. Sale consideration. Sale value is 20 lakhs. Sale value is 80 lakh and stamp duty value on the date of transfer is 85 lakh. So which we should consider 80 or 85. 80 or 85. Actual sale value is 80 lakhs. Stamp duty value on the date of sale is, you are given stamp duty value on the date of purchase as well as on the date of sale. Stamp duty value is 85 lakh. Let us see what is the difference between actual consideration and stamp duty value. If it exceeds 10%, only then stamp duty value is to be considered. So actual cost plus 10%. Actual cost plus 10%. That is 80 lakh plus 8 lakh will come to 88 lakh. 80 lakhs plus 8 lakh. 10% of 80 lakhs is 80 lakh. Okay. Actual cost plus 10% of 80 lakh, that is 8 lakh, will come to 88 lakh. Only if the stamp duty value is more than 88 lakh, you need to take stamp duty value. Here, stamp duty value does not exceed 10%. So ignore stamp duty value. So we take sale consideration as how much is taken as sale consideration? 80 lakhs. Cost of acquisition, we have already fixed it, 22 lakhs. We have to index that. Index cost is equal to 22 lakhs into, we are given all the indices, 348 and 100. This is a year of transfer and the property was acquired before 95, but even then we take only this on 2001 too. So 22 lakh into 348 divided by 100. It's 76.56 long-term capital gain. 80 lakhs minus 76.56. $3.44. Yes, this is the answer. 3.44. 3,44,000 is the answer. Long-term capital gain. An MCQ question. Now, let us also see something from the RTP or MTPs. MTP November 22. MTP November 22. Suresh entered into an agreement with Mukesh to sell his residential house located in New Delhi on 25/5/23 for 80 lakhs. Which was handed over the possession. Everything has happened in 2023-24. Okay, everything has happened in 2023-24. The date of agreement, the date of handing over the possession, the date of registration, everything has happened in 23-24. Now what further? This was entered into for 80 lakh. The sale proceeds was given in this manner. Okay, sale proceeds. 25,000 was paid by account pay check on the date of agreement. On the date of agreement itself, we have paid 25% and that is paid by account pay check. So this value is important. This information is something which we have to consider. This is important. 50% was given on the date of possession and balance on registration. You are given stamp duty value on 25/5/23. 25/5 means that is a date of agreement. And date of registration, the stamp duty value was 94.5. Okay. So let me write the stamp duty value on certain specific dates. Stamp duty value on the date of agreement is. Stamp duty value on the date of agreement is 25/5 is the date of agreement, 92 lakh. 92 lakhs. Stamp duty value on the date of registration is. On the date of registration, stamp duty value is 94.5 lakh. Which value is to be first considered? Which stamp duty value is to be first considered? Is it 92 lakh or 94.5? We told you there are two conditions. Advance has to be paid on the date of agreement, and that advance means only a part of the consideration. A part of the consideration has to be paid on or before the date of agreement, and that advance has to be paid by account paid, check or draft. I think both these conditions are satisfied. Advance is paid, 25% has been paid by account paid, check on the date of agreement. So we decide to pay 92 lakh. So stamp duty value to be considered is be considered is 92 lakhs. Okay. What is actual sale value? Actual sale value is 80 lakhs. Actual sale value. Okay. So now another point which we have to consider is whether that process 10%. Actual sale value plus 8%. Is stamp duty value higher than 10%? Yes. Stamp duty value is higher than. See, all these points we have to mention in the answer. All these points we have to mention the answer. It is higher than 10% of 80 lakhs. How do you understand that? 80 lakhs plus 10% equals 88 lakhs. 80 lakhs plus 10% is equal to 88 lakhs. Stamp duty value is higher than 88 lakhs. So what we take as sale consideration is, as per section 50C, we have to take stamp duty value as the sale consideration. 92 lakhs is the sale consideration. See, in this question, if the stamp duty value had only been 85 lakh, if the stamp duty value only had been 85 lakh, you don't take stamp duty value, just ignore the stamp duty value. If stamp duty value is less than 88 lakh, just ignore that. If stamp duty value is less than 88 lakh, just ignore stamp duty value. In that case, we take only the actual sale. But here, stamp duty value is more than 10% of actual sale consideration. Hence, we have to take that stamp duty value of 92 lakh. So, all these data is considered. That is everything over. This is also over. Now let us see. He has acquired this property on 1/4/2001 for 21 lakh. Index cost of acquisition. Index cost. Index cost is equal to 21 lakh into 348 divided by 100. 73 lakh 8,000. So balance long-term capital gain is 92 lakh minus 73 lakh 8,000. 18 lakh 92,000 is the long-term capital gain. 18 lakh 92,000 is the long-term capital gain. This is how we compute long-term capital gain. All right. Now there is one more point in the question that we have not discussed. We are going to discuss that portion. But you have to mention all these calculations in your answer. Why you took 92 lakh first? First of all, how did you choose between 92 lakh and 94.5 lakh? This you have to mention in the answer. After deciding that 92 lakh is taken, also mention that this is more than 10% of the consideration. All those theory part, I'll show you how it is answered in the answer key of the institute. Lot of theory has been mentioned here. Lot of theory. As per section 50C, where actual consideration is less than stamp duty value and that stamp duty value exceeds 110%, then stamp duty value shall be taken as full value. Now, if there is difference between the stamp duty value and the rate of registration agreement, what shall be the thing? That is what is of most important thing. Okay. So please keep in mind that you are mentioning all the notes relating to the calculation. All the notes relating to the calculation has to be specifically mentioned. Because when you come to capital gain, the thing is, There is no much of calculation which is required. Like the arithmetic calculation which we are doing only is the addition and the subtraction. No further mathematics is applied here. Only the addition and subtraction. And what the the valuer, he wants to know why this was added or why this was deducted. So we have to write the concept in each step. Okay, if we have when you are doing business income, we have added back inadmissible expense. You have to mention why this was added back. All those things are to be specifically mentioned. Please note that. Please note that. We are checking the concept. You are being checked for the concept clarity. So mention all these notes in the answers. This is how you have to answer for your exam. So specifically look into the way it has been answered in the ICAI study material or in the RTPs and LTPs, how it is answered. Please try to follow the same format. Okay. Part here regarding capital gain, the last part. When we discussed capital gain at the first instance, we had explained that 4 conditions have to be satisfied in order to treat a transaction as capital gain. First is there should be a capital asset. We have seen what is a capital asset. Such capital asset shall be transferred. Profit or gain shall arise. Transfer should take place in the previous year. Now we come to the last portion of this. If it is exempt, if there is any exemption which is granted under this chapter from capital gain, then you need not pay tax on such capital gain. And the exemptions regarding capital gains are governed by section 54 to 54 GB. When you do something, I'll give you exemption. When you do something which is mentioned in the section 54, I will give you exemption. Okay. So that is what we are discussing next. That is what we are discussing next. When can we claim exemption from capital gain? When can we claim exemption from capital gain? The exemption regarding capital gains are given in 2 areas. One is under section 10, our good old section of 10, section 10, which gives all the exemptions, and from 54 to 54 GB also, there are a lot of exemptions. Let us first see what is the exemption under section 10. Section 1037 is a specific section which deals with exemption from capital gains. The first point is, this is applicable to individual or HUA. Agricultural land in urban area is transferred. Urban area. The transfer is by way of compulsory acquisition. Compulsory acquisition. That land is used for agricultural purposes, and this exemption is applicable from assessment year 5-6 onwards. Exemption is applicable from assessment year 5-6 onwards. If all these above conditions are satisfied, then capital gain is exempt. Okay, so in other words, compulsory acquisition of urban agricultural land is exempt. Compulsory acquisition of urban agricultural land is exempt for individual or HUA. Compulsory acquisition. So that was regarding section 10 exemption. Now, under the chapter capital gain itself, there are a lot of exemptions. Let us first discuss section 54 in detail. And once you get the exemption under section 54, you can easily compare and identify. What are the other exemptions. What are the other exemptions? We can easily compare and identify. Let us first explain section 54. You have a residential house property in Chennai. Okay. This is sold on, let us take December 23, sold in December 2023. This is a long-term capital asset. Sale consideration is 50 lakhs. Right? Sale consideration is 50 lakhs. Now, from the sale considerations, since this is a long-term capital asset, I have deducted what is called index cost of acquisition. Index cost of acquisition is 20 lakhs. Index cost of acquisition. So long-term capital gain before exemption is equal to 30 lakhs. Long-term capital gain before exemption is equal to 30 lakhs. Okay. So let us see what are the exemptions that are possible here. What can we do if this property is sold? Is there any way by which I can claim exemption? Is there any way by which I can claim exemption? Let us see that. So when is this section 54 applicable? When is this section 54 applicable? Section 54 exemption is applicable to an individual or HUF. That is point number 1. This is applicable to individual or HUF. This individual or HUF has sold, this individual HUF has sold a long-term residential house property. Long-term residential house property. Okay, it shall be a long-term asset and that shall also be a residential house property. Okay, so that is sold. So that is why I told you, I have a property in Chennai that is sold in December 23 and I have a capital gain of 30 lakh, but I can claim exemption from 30 lakh. What shall be done to claim exemption under 30 lakh? What shall be done? What should I do now if I want to claim exemption for 30 lakh? If you want to claim exemption for 30 lakh, what should you do is you purchase one residential house property in India, sell one residential house property, purchase another residential house property. So you have to purchase one residential house property in India. So what I did is I purchased a new property, that is another property. It need not be a brand new. Another property in Bangalore. I purchased another property in Bangalore. And the cost of that Bangalore property was 25 lakhs. All right. What if I purchase two properties? I purchased 25 lakh in Bangalore and another property was purchased in Hyderabad for 5 lakhs. Two properties purchased. Bangalore property 25 lakh, Hyderabad property 5 lakh. Okay. If you purchase two house properties, I will also give exemption for the two properties which you have invested in. But one condition is that your capital gain shall not exceed 2 crore. Your capital gain shall not exceed 2 crore. Since in this case, the capital gain does not exceed 2 crore, we may claim exemption for two properties purchased. But keep in mind, this exemption of two properties, is applicable only once in your lifetime. Only once in your lifetime. What does that mean? Once you have claimed exemption for two properties in one assessment year, from then onwards, you can claim exemption only for one property purchased in any other subsequent year. For 1 year alone, I will tell you that, okay, you purchased two property, I will give you exemption for two properties. So if I want, I can claim here exemption for 30 lakh. Exemption under section 54 can be claimed for 50 lakh. Exemption under section 54 is claimed for 30 lakh. How do I get 30 lakh? 25 plus 5 lakh. 25 plus 5 lakh, I get exemption for 30 lakh. Okay. I get exemption for 30 lakh. 25 plus 5 is equal to 30. Understood. I get exemption for 30 lakh in under exemptions section 54 because I have purchased two properties. But don't ask me for those two property exemption in any other subsequent year. Next year again, if you purchase only two properties, I won't give you exemption for two properties. I'll give you exemption for only one property purchased. This two property exemption can be enjoyed only once in your lifetime. Two property exemption. Two property exemption is enjoyed only once in your lifetime. Okay, once in a lifetime option. From now on, you can claim exemption for only one property. Next year, again, you sell one property and purchase two another properties. Next year, you can claim exemption for only one property purchased. Anyway, let us continue with this example. For the sake of this example, let me assume that I have acquired only one property, that is one property in Bangalore for 25 lakh. One property in Bangalore is purchased for 25 lakh. Now, next question is, when should you go and purchase this Bangalore property? Is there any time limit? If you want to claim exemption, what is the time limit within which you have to purchase another property? Since that is a property, it can be either purchase or construction. A house can be either purchased or it can be constructed. It can be purchased ready-made or it can be constructed. If it is a purchase of property, that purchase shall be done 1 year earlier, 1 year backward, 1 year backward or 2 year forward, That is, purchase of the property shall be done between December 22 and December 25. Purchase of the property shall be done 1 year before December 23. December 23 is the year in which you have sold Chennai property, right? Sold Chennai property in December 23. So you may purchase a property in November 23 or October 23 or August 23. It can be done 1 year backward or 2 year forward. That is December 22 to December 25. And if that is a construction, that is to be done 3 year forward. 3 year forward. December 2026. We are looking for exact date actually. If it is 13th December 23, then you have to purchase before 13th December 26. Okay. So construction it is 3 year forward. Purchase it is 1 year backward or 2 year forward. This is the time limit within which you have to purchase a property. That is a time limit. Then next point. When will the time limit be counted from? Generally, that will be counted from the date of transfer. But if it is a compulsory acquisition, you cannot purchase a new property without receiving money. So the time limit will be counted only from the date of receipt of compensation. How much is amount of exemption? If you comply with all these rules, how much is the amount of exemption? Amount of exemption is lower of capital gain or amount invested in new house. Amount invested in new house. That is 25 lakh or 30 lakh, whichever is lower. So I claim exemption for 25 lakh here. So taxable long-term capital gain is 5 lakh. Taxable long-term capital gain is 5 lakh. Okay, this is how we compute exemption. Amount of exemption is lower of capital gain or amount invested in the new asset. Now, next question. Will the exemption be cancelled in future? Will the exemption be cancelled in future? Yes. Yes. The exemption given, the 25 lakh exemption given will be cancelled, will be taken away by the department if the new asset is sold within a period of 3 years. The new asset is sold within a period of 3 years, then the exemption given will be cancelled. So let us continue with this example. Suppose this Bangalore property was purchased in February 24. Bangalore property was purchased in February 2024. Okay. December 23, this is sold, and immediately a new property is purchased in Bangalore in February 2024. This Bangalore property shall not be sold before February 2027. Bangalore property shall not be sold before February 2027. That is the rule here. What happens if you sell it before February 2027? The exemption given for 25 lakh will be cancelled. Exemption will be taken back. Department will say that you have to pay taxes for that 25 lakh. How is that operated? How is that exemption cancelled? How is that exemption again charged to tax? Let us explain. Let me explain that. So this Bangalore property was purchased in February 24. We claimed exemption. When you purchase Bangalore property, I had asked you not to sell this up to 3 years. Not to sell this up to 3 years. But you didn't hear this. You didn't hear my advice. And what happened is, in December 2024, Bangalore property is sold. Bangalore property sold in December 2024. Property is sold in December 24. Let us compute capital gain for Bangalore property. Let us also assume that Bangalore property is sold for 55 lakhs. Sale consideration of Bangalore property is 55 lakh. Bangalore property is sold for 55 lakhs. Sale consideration 55 lakhs. See, this Bangalore property is a short-term capital asset because it was purchased in December 24 and that is sold in February 24. Purchased in December 24 for 25 lakh and sold in February 24 for 55 lakhs. So Bangalore property is a short-term capital asset. Since it is a short-term capital asset, what we deduct is cost of acquisition. There is no indexation. There is no indexation. What we deduct is cost of acquisition. Cost of acquisition of Bangalore property is 25 lakhs. Now, there is another thing which we deduct from this cost. What we deduct is the exemption which was earlier enjoyed. The exemption which was earlier enjoyed for this property, on purchase of this property, will be deducted from cost of acquisition. 25 lakh was exemption earlier enjoyed. That is deducted from cost of acquisition. So now the cost of Bangalore property becomes 0. So short-term capital gain will be 55 lakhs. Short-term capital gain will be 55 lakhs. See, this is how the exemption is subsequently charged to tax. This is how the exemption is subsequently charged to tax. When this exemption is cancelled, this 25 lakh exemption is cancelled, this exemption is deducted from cost of acquisition of the new property. Cost of acquisition of the new property. So cost of new property gets reduced. When cost gets reduced, capital gain increases. Just think, how much is actual capital gain of Bangalore property? How much is actual capital gain? Actual capital gain of Bangalore property is 55 lakh minus 25 lakh. 55 lakh minus 25 lakh, that is equal to 30 lakhs. That is the actual capital gain of Bangalore property. Bangalore property was purchased for 25, sold for 55. Means there is only a capital gain of 30 lakhs. But how that became 55 lakh now? The earlier exemption of 25 lakh gets mixed in this capital gain. 30 lakhs plus 25 lakh will make it 55 lakhs. Earlier, the exemption was enjoyed from long-term capital gain. Now, when you charge it back, its nature may become short-term capital gain. Its nature may become short-term, depending upon whether Bangalore property is sold within 2 years or 3 years. Depending upon whether Bangalore property is sold within 2 years or 3 years. So this is how we recharge the capital gain that was earlier exempt. When we charge it back, this is how we recharge. Okay. So how capital gain is subsequently charged? Deduct exemption enjoyed earlier from cost of acquisition of new asset. All right. Now, another thing is, see, we have a maximum time to purchase this property up to December 26. December 26 is the maximum time within which this property, new property can be purchased. Is it not? We do not know in December 23, we do not know whether we are going to construct a property or purchase a property. So if you take the maximum limit, the time limit is up to December 26. We have time up to December 26 to purchase the new property. So I thought that I need not purchase it in a hurry. Let me wait. let me go and check all the houses around the country in India and let us find the best one out of it and I'll choose the best property. So that way, I thought I will wait for a while. I'll wait for a while before purchasing the property. So I was waiting and waiting. And when I was waiting, another date came, July 31st, 2024. July 31st, 2024 is the date on which I have to file return for 23-24. Is it not? July 31st, 2024 is the date on which I have to file return for 23-24. So when I went to file return for 23-24, I could not enjoy any exemption because I had not purchased a property. I had not purchased a property by 24. I thought I'll wait for a while. Maybe I have time up to 26. So I'll wait for a while and then I purchased. But 2024, when I went to file return, the income tax department says that only if you purchase a property, I can give you exemption. So how come that there is a contradiction in the maximum time limit which is given? In order to compensate this contradiction, the Act says that if you could not purchase a property by 31st July 2024, no problem. Deposit this amount for which you want to claim exemption. The amount for which you want to claim exemption, deposit that in a special account called Capital Gain Account Deposit Scheme. Capital Gain Deposit Account Scheme. Keep this deposited in a special account. This is not a normal FD. This is Capital Gain Deposit Account Scheme. Capital Gain Deposit Account Scheme is the account in which you have to keep this deposited. And deposit this in Capital Gain Deposit Account Scheme before 31st July 24. The amount which you have deposited in this account, for that amount you can claim exemption. So this is a temporary account that you do, temporary account. And this is only a guarantee to the department that I will purchase a property before December 26. Purchase or construct, whatever. I will utilize this amount before December 2026. For giving this guarantee, you are keeping this deposited in a special account called Capital Gain Account Scheme. For the time being, I will give you exemption. If you show me that passbook. The passbook of Capital Gain Deposit Account Scheme, if you show me today, I will give you exemption. 31st July, you keep it deposited. I will give you exemption for 2023-24. But by December 26, I will again come back and ask you, where is the property? December 26, I will again come back and I will ask you, where is the property? If you don't show me a property by December 26, or else you show me that a property is purchased only for 25 lakh in December 26 or constructed in December 26 or purchased in December 25 only for 25 lakhs. Then the unutilized amount, the balance amount of 5 lakh will be taxable in December 26. On expiry of the maximum time limit of 3 years, I will tax that unutilized amount. So Capital Gain Deposit Account Scheme is a temporary account that is open for claiming exemption for the time being. For the time being, keep it deposited in a special bank account called Capital Gain Deposit Account Scheme. If you don't utilize that within a period of 3 years, the maximum time limit of 3 years, which is given in this question, is it not? Maximum time limit is here 3 years, either to purchase or construct. If you don't utilize that within a period of 3 years, the amount remaining unutilized in this account will be taxed as capital gain on expiry of the maximum time limit of 3 years. So this is regarding Section 54. Section 54 exemption is available to individual or HUF. The asset which he has to sell is a long-term capital asset, being a residential house property. The asset which he has to purchase is one residential house property in India. You may purchase 2 properties if your capital gain is less than 2 crore. I will give you exemption for 2 properties, but that is only once in your lifetime. From now on, don't ask for 2 property exemption. When to purchase? If it is purchased 2 years forward or 1 year backward, construction is 3 years forward. Time limit is counted from the date of transfer. In case of compulsory acquisition, from the date of receipt of money. Amount of exemption is lower of capital gain or amount invested. Exemption will be cancelled, will be taken back by the department if the new property is sold within a period of 3 years. And that is cancelled in an indirect manner. That is, the amount is deducted from the exemption enjoyed earlier is deducted from cost of acquisition of the new property. That way your cost will be decreased and your capital gain will be increased. If you could not purchase the property immediately, keep it deposited in a capital gain deposit account scheme. Okay. Now, there is one more point here. From assessment year 24-25 onwards, there's an amendment in this section from assessment year 24-25 onwards. And what does the section say is that the maximum exemption which you can enjoy here is only 10 crore. The maximum exemption which you can enjoy here is only 10 crore. Now, let me explain that. How to explain that? A person has sold a property for 50 crore. Let us make all these in crores. Index cost of acquisition is 20 crore. Long-term capital gain before exemption is 30 crore. Okay. He invested in a new house. He invested in a new house. New house he purchased for 15 crore. Single house. Single house, purchase cost of a single house is 15 crore. 15 crore. Okay. Here exemption is lower of capital gain or amount invested. Lower of capital gain or amount invested, that is 30 crore or 15 crore. 30 crore or 15 crore. We get 15 crore. But 15 crore exemption is limited to 10 crore. 15 crore exemption is limited to 10 crore. So taxable capital gain here will be 20 crore. Okay. Agreed. Lower of capital gain or amount invested. I agree everything, but again, exemption maximum is only 10 crore. So this is a new amendment from assessment year 24-25. This 10 crore maximum limit. Okay. Let's take a 10 minutes break. All right. Let's take a 10 minutes break and I will join after 10 minutes. Let us continue now. Okay, let us continue. So we had discussed section 54 regarding exemption from capital gain. Now, similarly, let us quickly discuss the other exemptions as well. 54B, 54D, EC, and F. All those are similar. That is why I explained section 54 in detail. And once, if you have identified section 54, you'll be able to easily complement section 54B and other sections. 54B, the exemption is available to individual or HUF. 54 is also for individual HUF. That's which you have sold is long-term or short-term agricultural land. Long-term or short-term agricultural land. See, agricultural land situated in an urban area. Agricultural land situated in urban area because rural agricultural land is not a capital asset. So there is no point in claiming exemption, whereas urban agricultural land, we can claim exemption. And what to purchase? You have to purchase another agricultural land. Sell one agricultural land, purchase another agricultural land. Time limit is 2 years forward. 2 years forward. From which date the time limit will be counted? Date of transfer. Amount of exemption is lower of capital gain or amount invested in the new asset. Same rule. When will the exemption be revoked? Exemption will be revoked if this new asset is transferred within a period of 3 years. And if the exemption is revoked, how will the capital gain be recharged? That is by deducting it from the cost of new asset. So all provisions are similar. See, all provisions are similar here. Except that it is an agricultural land which is sold and agricultural land which is purchased. If you cannot, if you could not purchase an agricultural land immediately, do one thing, keep it invested in capital gain deposit account scheme. Okay. That was regarding 54B. Next is 54D. Next is 54D. 54D is applicable to any person. This is regarding long-term or short-term sale of long-term or short-term land and building. But this land and building is forming part of your industrial undertaking, and that is compulsorily acquired by government. Here we are talking about only a compulsory acquisition of your land or building. Compulsory acquisition of land or building is done by the government. Okay, compulsory acquisition. It's a land or building of your factory. And what is to be purchased? One land or building of your factory is sold, land or building of, purchase another land or building for your factory. Purchase land or building for your factory. Time limit is 3 years forward. Then time limit will be counted from date of receipt of money. Amount of exemption is lower of capital gain or amount invested. The new asset is to be transferred within a period of 3 years. Then the exemption will be cancelled. How the exemption will be recharged? Same rule, deduct exemption from the cost of new asset. If immediately you could not purchase, keep it invested in capital gain deposit scheme. So all rules are similar. So this is residential house property sold, residential house property purchased. This is agricultural land sold, agricultural land purchased. This is land or building of factory compulsorily acquired by government, land or building purchased. So everything is similar. Only the nature of asset which you have sold has changed. Now let us come to 54EC. 54EC is applicable to any person, and this person has sold long-term land or building or both. Long-term land or building or both. It's a long-term capital asset. What shall be purchased? You have to purchase bond of certain specific companies like National Highway Authority of India, the NHAI, Rural Electrification Corporation, REC, Power Finance Corporation, PFC, Indian Railway Finance Corporation, IRFC. These bonds are to be purchased and the life of the bond shall be minimum 5 years. Life of the bond shall be minimum 5 years. Okay. So sell any land or building of your, sell land or building, any land or building. It can be residential, it can be commercial, it can be relating to your factory, it can be relating to your showroom, whatever. Sell land or building, but that shall be a long-term capital asset. Purchase these bonds. What is the time limit within which you can purchase these bonds? What is the time limit? Here you have a time limit of only 6 months. 6 months from the date of transfer, you purchase these bonds, and the maximum investment which is possible is only 50 lakhs. See, under 54, we discussed that the maximum exemption possible is only 10 crore. Here it is 50 lakhs. And what is the time limit from which we count the period? 6 months will be counted from the date of transfer. What is amount of exemption? Lower of capital gain or amount invested. Everything similar. Will the exemption be revoked? Yes, the exemption will be revoked if the new bond is sold within a period of 5 years, not 3. New bond is sold within a period of 5 years, not 3. Because the life of the bond here itself is 5 years. So you cannot sell this bond before that. Also, do not pledge these bonds to take a loan. Do not pledge these bonds to take a loan. If the loan is the bond is pledged and you take a loan on its security, then also the exemption will be cancelled. If the exemption is cancelled, how do you charge this capital gain? The section is slightly different. You charge it as directly long term. Earlier, exemption was enjoyed from long term. Again, charge it as long term capital gain. And since we have only a 6 months time here, to purchase the bond, capital gain deposit account scheme is not applicable. Capital gain deposit account scheme is not applicable. Go and immediately purchase these bonds. Then only we can claim exemption. If you keep them invested, money is kept invested in a capital gain deposit account scheme, exemption is not possible. So the 54 EC is slightly different in the sense when you recharge the capital gain, there is no indirect method. Exemption enjoyed earlier will be directly charged as long-term capital gain, and there is no capital gain deposit account scheme applicable. Maximum exemption possible in 54 EC is only 50 lakhs. 54F, this exemption is applicable to individual HUF. An individual HUF should have sold any long-term capital asset other than residential house property. Any long-term capital asset other than residential house property is sold. Long-term capital asset other than residential house property. Okay. And what should you purchase? One residential house property in India. So what is the difference between 54 and 54F? I sell property, I sell a house, purchase a house. I can claim exemption under section 54. Okay, I sell a house, purchase a house. I can claim exemption under section 54. I sell gold. Gold meaning any asset other than residential house property is sold, and now house property is purchased. I sell gold and house property is purchased, then I can claim exemption under 54F. I hope you get the difference. 54 is for selling flat, purchasing flat. Need not be flat, it can be house. Selling house, purchasing house, section 54. Selling gold or selling shares, selling jewelry, then I purchase a house, I get exemption under 54F. 54F. So long-term capital asset other than residential house property is sold. You purchase one residential house property in India. Maximum exemption is 10 crore. Time limit to purchase a property is same. Purchase 2 year forward or 1 year backward. Construction 3 year forward. Time limit is counted from date of transfer. But regarding exemption, there is a new rule. Let me explain that. This is a case where a residential house property, okay, residential house property is sold in Chennai and I purchase Bangalore property. Bangalore property is purchased for 25 lakhs. Bangalore property is purchased for 25 lakhs. Okay. I sold residential house property. I'm purchasing residential house property. Bangalore property, 25 lakhs. Exemption is under section 54, is it not? This is exemption under section 54. Selling residential property, buying residential property. And my exemption was 25 lakhs. So taxable capital gain was 5 lakhs. This is regarding sale of property in Chennai and purchase of property in Bangalore. Now, another example, I'm selling my jewelry. I'm selling my jewelry. If jewelry is sold and a house is purchased, then you are claiming exemption under section 54F. Or it can be any asset other than house property is sold and I'm purchasing a house, then I'll be claiming exemption under section 54F. Let me continue. 50 lakhs, 20 lakhs, 30 lakhs before exemption. Amounts are the same. I'm selling jewelry for 50 lakh. The index cost of acquisition of the jewelry was 20 lakh. Now long-term capital gain before exemption is 30 lakh. Okay. Now I'm purchasing Bangalore property. Bangalore property is purchased for 25 lakh. Bangalore. Let us assume this property in Bangalore was purchased by selling your jewelry. Then also you can claim exemption, but then the exemption will be under 54F. Now here, exemption is calculated by a specific formula. Here the rule was, under section 54, the rule was, amount of exemption is lower of capital gain or amount invested, whichever is lower, 30 lakh or 25 lakh, whichever is lower. That was the calculation here. But in this case, the exemption is calculated by a formula, and that formula is capital gain into amount invested in the new property, divided by net sale consideration. Net sale consideration. Let me ask you one thing. How much did you receive by selling jewelry? You received 50 lakhs, is it not? When you received 50 lakhs, you invested only 25 lakh in the new property, right? You received 50 lakh, but you invested only 25 lakh in the new property, 25 lakh, which means only half of the sale consideration was invested. 25 divided by 50, amount invested, capital gain into 25 lakhs divided by 50 lakhs. Only half of the consideration is invested in the new property, right? Half of the consideration is invested. So your exemption will be only half. Your exemption will also be half. That is, the exemption is limited to the amount which you have invested from the sale consideration. Amount which you have invested from the sale consideration. You receive 50 lakh, you invested only half of it. I'll give you exemption only in that ratio. So here your exemption will be 50 lakhs. Even if you invest 25 lakh, even if the cost of Bangalore property is 25 lakh, even if the cost of Bangalore property is 25 lakh, you won't get exemption for 25 lakh. You would get exemption only for 15 lakhs. Did you understand this? Okay. Did you understand this calculation? So this is a calculation, capital gain into amount invested divided by net sale consideration. This is how we give exemption. And the balance taxable capital gain will be 15 lakhs. So the section is slightly different from others. In all other sections, the amount of exemption would be, is lower of capital gain or amount invested. Lower of capital gain or amount invested. But in this section, this exemption is calculated by a formula, capital gain into amount invested divided by net sale consideration. That is the amount which you have invested out of the consideration received. In that ratio, I'll give you exemption. In that ratio. Now, what is net sale consideration here? What is NSC here? NSC, what do you mean by net sale consideration? Net sale consideration is equal to sale consideration minus expenses on transfer. Sale consideration minus expense on transfer is net sale consideration. Okay, if there is any expense on transfer, deduct that and see how much is invested. For example, here if the expense on transfer is 1 lakh, then the ratio will be 25 lakh divided by 49 lakh. If the expense on transfer is 1 lakh, then the ratio will be 25 divided by 49. Okay, so that is regarding This exemption under 54F. Similarly, the new asset is sold within a period of 3 years, exemption will be cancelled. And when you revoke the exemption, the entire exemption enjoyed earlier will be directly charged as long-term capital gain. And also, capital gain deposit account scheme is applicable, but that is if that is not fully utilized, the amount remaining unutilized will be taxed. So these are the rules regarding exemptions. So we'll do one question on that, on the exemption part. This was a question which was asked in the last exam, November 23 suggested answer. Let us do this question. This is a question, I think, upon 54F. 54F. Mr. Aryan, a resident individual, aged 58 years, he sells unlisted shares in a private sector company. Shares he's selling, shares. So when he's selling shares, and he's now purchasing, I think he's purchasing a house. So we are going to claim exemption under 54F. He has sold shares in a private sector company for 10 lakh. The shares were purchased in 2012 for a consideration of 2 lakh. Aryan has paid brokerage of 2,000. He has deposited 5 lakh in capital gain deposit account scheme, that is before filing return of income for assessment year 24-25. And on April 30, 25, he withdraws 4,50,000 and purchases a new house in Delhi on May 1. It is May 1, 25, sorry. May 1, 25 for 4,50,000. May 1, 25, he purchases a new property for 4,50,000. The CIIs are given. You have to give me what is the amount of capital gain taxable for assessment year 24-25 and also what will be the tax treatment of the unutilized amount, because he had invested 5 lakh and he had purchased a new house only for 4,50,000. So what will be the tax treatment of the unutilized amount? Let us first calculate how much is capital gain for 24-25. This is an exemption under section 54F. Okay. This is an exemption under section 54F. 54F. So let us compute capital gain. Sale consideration. Sale consideration of shares. He's selling shares here. Selling shares and purchasing property. Okay, so 54F will be coming into the handy. 10 lakhs. 54F will be coming into the picture here. Less indexed cost of acquisition. Since this is long term, we have to calculate index cost of acquisition. Index cost of acquisition is 2012, 13. So 2 lakh into 348 divided by 200. That is the CIIs. 2 lakh into 348 divided by 200. All right. So 3,48,000. There is expense as well, right? There is expense on transfer, brokerage. So let me deduct that first because I have to identify how much is net sale consideration. Expense on transfer. Expense on transfer is 2,000. So net sale consideration is 9,98,000. What is long-term capital gain before exemption? What is long-term capital gain before exemption? 9,98,000 minus 3,48,000. that is 6,50,000. So we have the net sale consideration here. We have, we also have found out how much is long-term capital gain before exemption. Okay. Now from this, let us deduct exemption under section 54F. Exemption under section 54F. Exemption under section 54, let me write down the formula here. It is capital gain into amount invested either in the new property or in the capital gain deposit scheme or in the capital gain deposit account scheme. Okay. Divided by net sale consideration. Divided by net sale consideration. This is the formula by which we calculate capital gain. Okay. Here, you did not purchase a property immediately, but you have invested 5 lakh in the capital gain deposit account scheme. See, 5 lakh. 5 lakh is the amount deposited in capital gain deposit account scheme, but you utilize 4,50,000. That comes in the next year. That we'll see in the later year. Right? So now you have invested only 5 lakh. I will give you exemption proportionately. So your exemption would be, how do we compute exemption here? 6,50,000 into amount invested is 5 lakh divided by 9,98,000. This is a formula with which we can claim exemption. Capital gain is 6,50,000. You received 9,98,000, but you invested only 5 lakh. Only in that proportion, 5 divided by 9,98,000, I'll give you exemption. 6,50,000 into 6,50,000 into capital gain into 5 lakh, that is amount invested, divided by net sale consideration 9,98,000. So this is your taxable long-term capital gain. Taxable long-term capital gain. Your capital gain for assessment year, we have calculated for assessment year 2024-25. This is the year for which we have computed capital gain. Okay. So we've invested 5 lakh and we got an exemption of 3,25,651. So that part of the question is over. That part of the question. Now let us come to this part. On April 30, 2025, he withdraws 4,50,000. He had invested 5 lakh. Now he is withdrawing 4,50,000 and he is purchasing a new property for 4,50,000. What does that mean? There is an amount which is remaining unutilized. Unutilized is there, and the amount of unutilized amount in capital gains deposit account scheme is capital gain deposit account is 50,000. Okay. So that you had earlier promised me that you will be purchasing a new house for 5 lakh. That is what is capital gain deposit account scheme. That is a guarantee which is given to the income tax department that you will be purchasing a new property for 5 lakh. Immediately, I could not purchase one, but definitely I will purchase one within that time limit. That is what is called as this capital gain deposit account scheme. So immediately you could not purchase a property, so you kept it invested in a capital gain deposit account scheme, and that amount of capital gain deposit account scheme for which you have invested is 5 lakh. Okay. When you invested 5 lakh, you purchased a property only for 4,50,000. You did not keep up that promise. So the 50,000 is remaining unutilized in the capital gain deposit account scheme. The amount which is remaining unutilized in the capital gain deposit account scheme has to be taxed on expiry of the maximum time limit. Maximum time limit. I will wait till the maximum time limit. That is, maximum time limit here is 3 years. Because you can either purchase a property or we may construct a property. You never know what you are doing, what you are going to do in future. Whether you will be purchasing a property or whether you will be constructing a property, you never know that. Is that not? So I will wait till the maximum time limit. I will wait till the maximum time limit, and the maximum time limit is 3 years. 3 years from which date? Date of transfer, 17th May 23. So 3 years will expire on 17th May 2026. So on 17th May 2026, you had sold this share in 17th May 23. You have a time up to 2026 to purchase or construct a property. So I'll wait till that time. 17th May 26, I will wait. And 17th May 26, when I see that there is an unutilized amount, I will tax it. So which financial year is it? Financial year is 2026-27. So assessment year is 2027-28. Okay. What is amount taxable in assessment year 27-28? That is next question. Whether the entire 50,000 is taxed. Whether the entire 50,000 is taxed. Let us discuss this question once again. See, when you invested 5 lakh, did you get exemption for 5 lakh? Did you get exemption for 5 lakh? When you invested 5 lakh, how much was the exemption for? No, you did not get exemption for 5 lakh. Instead, when you invested 5 lakh, you got exemption for only 3,25,651. See, you invested 5 lakh and we calculated by that formula, capital gain into amount invested divided by net sale consideration. So when 5 lakh was invested, you got exemption only for 3,25,651. If you had enjoyed exemption for 5 lakh earlier, you invested 5 lakh and you also got exemption for 5 lakh, then the entire 50,000 would be taxable. But when you invested 5 lakh, only a proportion of 5 lakh was allowed as exemption. When you invested 5 lakh in capital gain deposit account scheme, only a proportion of 5 lakh was allowed as exemption. So when there is an unutilized amount lying, 50,000 would not be fully taxed. Only the same proportion would be taxed. I hope that idea is clear. I invested 5 lakh. I only got 3,25,651 exemption. So when there is unutilized amount 50,000 in that account, only that same proportion would be taxed. So let us see what is the formula by which we claim exemption. Let me put that formula once again. The formula for claiming exemption is capital gain into amount invested divided by net sale consideration. Is it not? Capital gain into amount invested divided by net sale consideration. This is a formula by which we claim exemption. Let me slightly change this formula. Isn't the formula same? Amount invested into capital gain divided by net sale consideration. Isn't the same? Isn't it the same? Okay. Same formula. Capital gain into amount invested by sale consideration or amount invested into capital gain by sale consideration. Both are same. So let me again substitute it. 5 lakh into, when 5 lakh was invested, how much of 5 lakh was allowed as exemption? How much of 5 lakh? 5 lakh into 6,50,000 divided by 6,50,000 divided by 9,98,000. When 5 lakh was invested, you got exemption only for this amount. 5 lakh into 6,50,000 divided by 9,98,000. I think the calculation will come to the same amount. Let us do that. 5 lakh into 6 lakh 50 divided by 9 lakh 98. That is 5 lakh into 650 divided by 998. Three lakh 25, 651. Same figure, same figure. So when 5 lakh was invested, 5 lakh into this portion would be amount allowed as exemption. So if there is an unutilized amount unutilized into same ratio will be taxable. Amount unutilized into capital gain divided by net sale consideration is taxable. Unutilized amount of 50 is not fully taxable. Unutilized amount of 50,000 is not fully taxable. Okay, the proportion of exemption only would be taxable. Unutilized amount of 50,000 is not fully taxable, but the same proportion in which, same ratio in which we had claimed exemption. When 5 lakh was invested, 5 lakh into 650 by 998 was allowed as exemption. So 50,000 is remaining unutilized in that 5 lakh, only that proportion will be again taxed. So amount taxable will be 50,000 into 6 lakh 50 divided by 9 lakh 98. If 50,000 is remaining unutilized, only the proportion which was earlier exempt will be now taxed. 32,565 will be taxed. Only 1 by 10 of the invested amount is remaining unutilized. So 1 by 10 of the exemption also will be cancelled. Is it not? 1 by 10 is remaining unutilized. 1 by 10 of earlier exemption will also be cancelled. For the amount which you have already utilized, you can enjoy exemption. For the amount which you have already utilized, you can enjoy exemption. So 32,565 will not, amount of, 50,000 is remaining unutilized, 32 will be taxed. So this is a question from the November suggested answer. So now let us come to the last topic of capital gain, that is computation of tax liability. Computation of tax liability. Generally, long-term capital gain is taxable at a flat rate of 20%. All long-term capital gains are taxable at flat rate of 20%. And let me explain in this way. General rule is all long-term capital gain taxable at 20%. And all short-term capital gains, there is a general rule, which means there are certain exceptions. All short-term capital gains are taxable at slab rate. Slab rate, that is just like salary or house property or business income or any of your other income. Now the exception. You have a capital gain on sale of 4 assets. On sale of 4 assets. They are listed equity shares or listed, okay, equity oriented mutual fund. Then the business trust. You need not know about business trust and all. That is not in your syllabus. Or units of business trust. Something like UTI and all. And there is a ULIP. These 4 assets are sold. Okay, these 4 assets are sold. And from the sale of these 4 assets, you may either have long-term capital gain or short-term capital gain. That are those 2 possibilities. You sell these assets and you have either short-term capital gain on these 4 assets, or you have long-term capital gain on these 4 assets. Okay. Short-term capital gain is taxable. Short-term capital gain is taxable at a flat rate of 15%. Half the normal rate. Half the normal rate. See, generally short-term capital gain is taxable at a maximum rate of 30%. If you are following the slab rate, our maximum rate of tax will be 30%, the maximum. But if it is a short-term capital gain from sale of equity shares, sale of equity-oriented mutual fund or a unit of business trust, then short-term capital gain would be only 15% of the normal rate. That is half the normal rate. Half the normal rate means maximum 30, here it will be only 15%, and that is flat rate, no slab rate applicable. And you sell these types of asset and you have a long-term capital gain. That long-term capital gain is also taxable at half rate. That is normal long-term capital gain is taxable at 20%, but here it is taxable only at 10%. This is given by section 111A. Short-term capital gain special rule is given by section 111A, and this is given by 112A. So generally, long-term capital gain is taxable at 20%, and short-term capital gain is taxable as per slab rate, which means maximum rate is 30%. Under slab, the maximum is 30%. But if you have a capital gain from sale of these 4 types of assets, listed equity shares, listed equity-oriented mutual fund, units of business trust, and ULIP, and this capital gain is short-term, then both these short-term and long-term are taxable at half rate. That is, here it will be 15 and here it will be 10. So what is the idea behind? This is to promote more and more investment in stock markets. Let more and more people come and invest in shares. They need to pay only half the normal tax rate. That is the idea behind the introduction of this special rule. Okay. And now one more thing. When you compute capital gain as on under 112A, there is no indexation, because you are paying, even otherwise you are paying only small amount as tax, is it not? And another thing, one more, this taxable at 10% is on amount exceeding 10 lakh, exceeding 1 lakh. Only long-term capital gain in excess of 1 lakh is taxable at 10%. Only long-term capital gain in excess of 1 lakh is taxable at 10%, meaning long-term capital gain is 1,20,000. Long-term capital gain is 1,20,000. Only 20,000 is taxable at 10%. 20,000 is taxable at 10%. Again, there is a basic exemption of 1 lakh applicable for this long-term capital gain. So there are a lot of benefits if you invest in shares. Any capital gain up to 1 lakh, long-term is not taxed. Even if it goes above 1 lakh, only that excess is taxable, that too at 10%. And since these benefits are given, there is no indexation. There is no indexation since these benefits are given. Okay. And one more thing. Another point regarding this long-term capital gain is, in case these assets are purchased before 1st February 2018, these equity shares were purchased before 1st February 2018, then your cost will be, while you compute the actual cost, there are certain steps. How to compute actual cost of assets is for purchase before 1st February 2018. Because 1st February 2018 was the year in which all these benefits were introduced. All these taxation rules were introduced. So when the asset is purchased before 1st February 2018, how do you find out cost of those assets? First of all, compare the fair market value as on 31st January with the actual sale consideration. Compare fair market value with the actual sale consideration, and fair market value as on 31st January 2018 is the sale consideration. Choose whichever is lower. That lower amount is compared with the actual cost. See, the lower amount is compared with the actual cost. Fair market value or sale consideration, the lower amount. Compare that with the actual cost, and then you can take whichever is higher. So in short, if the sale consideration is not lower than fair market value, Sale consideration is not lower than fair market value. Sale consideration is higher than fair market value. Then how do we compare as fair market value or actual cost, whichever is higher? Okay. Let's see if there is any question from this. Let's take this question. This is a question upon this. Now, which fair market value taken shall be taken? Is it the highest value or the lower value or the average value? The highest value as on 31st January 2018 is to be taken. The highest fair market value as on 31st January 2018 is to be taken. Okay. So this is a question. This is from RTP number 21. Let us see this question. Mr. Animesh has sold 10,000 listed shares at 480 per share. 480 per share is the value on which he has. These are listed shares, okay? So the special rule is applicable. An Indian company, he sold this on 15/9/23. These shares were purchased before 2018 and the actual cost was 100. STT has been paid. On 31st January 2018, this is the values. 31st January 18, this is a fair market value. Highest price is 300, average is 290, lowest is 280. We have to take the highest value. Okay, so let us see how do we compute capital gain. So these are listed equity shares. This is a long-term capital gain. So this is a case where we have to pay tax under 112A. But when we take 112A, as I told you, there is no indexation. And if the share is purchased before 1st February 2018, there is a special way by which the shares are purchased before 1st February 2018. This is how we take the cost of acquisition. This is how we take the cost of acquisition. So let us do these steps. Let us do these steps. First, I'm comparing lower of the highest fair market value on 31st January 18. Fair market value as you know, in stock exchanges, the fair market value keeps on fluctuating. If you have seen these news channels and all, you'll be seeing this value being scrolled at the bottom of your TV screen. You can see the value of shares and that keeps on fluctuating minute by minute, second by second. So on that day, 31st January 2018, what is the highest value which is quoted in the stock exchange for that particular share? That is what we have to take. So which fair market value will we take here? Highest quoted fair market value. Highest quoted fair market value. Highest quoted fair market value for the share is 300. 300. Okay. Compare that with the selling price. Compare that with the selling price. Selling price is 480. Selling price is 480. From these, choose whichever is lower. Choose whichever is lower out of this. So we choose 300. That is 300. That is chosen. Now what we have to take is find out the actual cost. Actual cost is I think 100. 100 is the actual cost. He has purchased it on 5th April 2016 at 100 per share. So actual cost is 100. Now compare these two values, 300 and 200. Compare 300 and 100. Okay, these two values and choose whichever is higher. Higher is 300. So 300 will be taken as cost of acquisition. Cost of acquisition is finally taken at 300. Selling price is 480. Profit is 180. Profit is 180. 180 into 10,000, that will be 18 lakh. So this is our answer. 18 lakh is your answer. Okay. Let us take another part, the last part in this chapter, that is regarding unexhausted basic exemption limit. Unexhausted basic exemption limit. This is the last point, maybe in this chapter, which we have to discuss. Unexhausted basic exemption limit, which means a basic exemption limit which is not fully utilized. That is what is called as unexhausted basic exemption limit. Okay. Normally, we told that when there is long-term capital gain or short-term capital gain under 111A, or there is a long-term capital gain under 112A, all these are taxable at flat rate, is it not? This is taxable at a flat rate of 20%. Flat rate. Flat rate means there is no basic exemption limit possible. This income is taxable at flat rate. This is again taxable at flat rate. Short-term capital gain under 111 is taxable at a flat rate. This is also taxable at a flat rate. So there are three incomes now in this chapter which are taxable at flat rate. One is a general capital gain. Second one is a capital gain from equity shares and those equity-oriented mutual funds which are also taxable at a flat rate. So if a person has income from house property, 3 lakhs, and income from house property is 3 lakh, and long-term capital gain is 2 lakhs. Long-term capital gain is 2 lakh. See, this long-term capital gain, if it is a general capital gain, that will be taxable at a flat rate of 20%. And this will be taxable at a flat rate of 20%. And this will be taxable as per the usual slab. That is basic exemption limit. Up to 2,50,000 it is exempt. From 3 lakh it will be exempt up to 2,50,000. Only the balance 50,000 will be taxable and so on. That is a general rule. Long-term capital gain is taxable at a flat rate of 20%. 2 lakh, it has to be fully taxed. Now let me change this example. Income from house property of a person is only 1,50,000. He has a long-term capital gain of 2 lakhs. Long-term capital gain of 2 lakhs. In this question, this person has got something called as unexhausted basic exemption limit. Unexhausted basic exemption limit. What do you mean by unexhausted basic exemption limit? Basic exemption limit which is not fully utilized. Basic exemption limit which is not fully utilized. How much is the basic exemption limit which is not utilized? His eligible basic exemption limit is 2,50,000. Of course, if he is following under the old regime. Old regime, if he is following, his unexhausted basic exemption limit is 1 lakh. Because his eligible limit is 2,50,000. But since his income is only 1,50,000, he has utilized only 1,50,000. He has utilized only 1,50,000. So there is an unutilized basic exemption limit of 1 lakh. The Act says that this unexhausted basic exemption limit of 1 lakh can be deducted from 2 lakh. Can be deducted. If there is any unexhausted basic exemption limit, you can deduct that unexhausted basic exemption limit from long-term capital gain of 2 lakh. So, long-term capital gain of 2 lakh will not be taxable at a flat rate of 20%. Instead, here the tax liability will be 2 lakh minus 1 lakh, that is equal to 1 lakh into 20%. Into 20%. So that will be only 20,000. Did you understand this step? Did you understand this calculation? So long-term capital gain is 2 lakh. If there is no unexhausted basic exemption limit remaining, as in example 1, there is no unexhausted basic exemption limit remaining because we have fully utilized the basic exemption limit. So there, 2 lakh will be taxable at a flat rate of 20%. No doubt about that. 2 lakh will be taxable at a flat rate of 20%. But in the second case, In the second case, income from house property is 1,50,000, which means there is an unexhausted basic exemption limit of 1 lakh. Any remaining basic exemption limit can be adjusted to long-term capital gain, and only the balance need to be taxed at flat rate of 20%. But this benefit is applicable only for, keep in mind that this benefit is applicable only for resident individual or resident HUF. Only these two persons can enjoy this benefit. Only for resident individual and resident HUF, this rule is applicable. NRI cannot use this method. NRI, even if he has unexhausted basic exemption limit, he will pay 2 lakh into 20%. So this is the rule for long-term capital gain. This is also the rule for short-term capital gain under 111A. This is also the rule for short-term capital gain under 111A. 111A means you have sold shares. 1,50,000, 2 lakh. Here also the same rule is applicable. Here also the same rule is applicable. He has unexhausted basic exemption limit. So that unexhausted basic exemption limit, but the only difference is it will be taxed at 15% because 111A, the tax rate is 15%. So here the tax liability will be 15,000. Here the tax liability will be 15,000. Okay. Right. Now, same is the rule regarding long-term capital gain under 112A. Long-term capital gain under 112A. What is long-term capital gain under 112A? That flat rate of 10%. But let me slightly change the figure there. Let me slightly change the figure. Long-term capital gain under 112A. Income from house property is 1,50,000. Long-term capital gain under 112A is 2,20,000. Here again, there is an unexhausted basic exemption limit of 1 lakh. Unexhausted basic exemption limit of 1 lakh. How do we tax this? 2,20,000 minus 1 lakh minus. There is a general exemption of 1 lakh as well. There is a general exemption of 1 lakh. See, 112A even otherwise says that only long-term capital gain exceeding 1 lakh is taxable at a flat rate of 10%. Don't you remember that? Here, there is only this long-term capital gain exceeding 1 lakh is taxable at a 10%. So we can deduct base unexhausted basic exemption limit and also the general exemption of 1 lakh, which means the balance remaining is 20,000. That into, not 20. How much is that? Yes, 20,000 itself. 20,000 into 10%. That will be tax payable. 20,000 into 10%. 2,000 will be the tax payable. So that same rule is applicable. The adjustment of unexhausted basic exemption limit is applicable for general long-term capital gain and those special short-term capital gain and special long-term capital gain. But this rule is applicable only for resident individual or resident HUF. Okay. Now let me come to that rebate portion. I hope you know computation of tax liability, and there is a rebate under the old regime up to a person if a person has an income of less than 5 lakh. Under new regime, rebate is applicable for a person who has an income up to 7 lakh. Old regime, so let me explain what is rebate. What is rebate under section 87A? Under old regime, rebate is applicable of only if income is less than or equal to 5 lakh. Income is less than or equal to 5 lakh. Before that, this scheme is applicable. Rebate under 87A is applicable only for a resident individual. This is not applicable to HUF. This is applicable only for a resident individual. Rebate under section 87A. This is a reduction in the tax liability which is given. Reduction in the tax liability which is given. The limit is less than 5 lakh. Income shall be less than 5 lakh. And maximum rebate is Maximum rebate is 12,500. Maximum rebate is 12,500. Under the new regime, that is 115 BSc, rebate is applicable for a person whose income is less than 7 lakh. Whose income is less than 7 lakh. 7 lakh or equal to 7 lakh. And the maximum rebate is equal to 25,000. Maximum rebate which is possible is 25,000. Okay. Old regime, income is less than 5 lakh, maximum is 12,500. New regime, income is less than 7 lakh, and maximum rebate possible is 25,000. But in both the cases, there is one point common. There is one point common for both these sections. And that point which is common is no rebate for tax payable under 112A. No rebate for tax payable under section 112A. No rebate. No rebate for tax payable under 112A. See, for this 112A, we are even enjoying so many other benefits, like tax rate is the minimum 10%. Only on an amount exceeding 1 lakh is taxable. So even otherwise, the tax which you are paying will be too small. So from that tax, from this tax, long-term capital gain, there is no rebate for this tax which you are paying. For short-term capital gain under 111A and all these taxes which we can claim rebate, provided these conditions are satisfied. These conditions are satisfied, you can claim rebate. For no rebate for a tax payable under 112A. Okay. So let us do that question as well. Let us see this question. RTP May 24. RTP May 24. Garg is aged 45 years. He is a resident in India and is having a total income of 5,70,000. He is having a total income of 5,70,000. 5,70,000 comprises of long-term capital gain under section 112. Okay. Then there is long-term capital gain under 112A of 1,50,000. Short-term capital gain under 111A of 1 lakh, another income of 2,50,000. Let's just prepare a total income statement. Let's just prepare a total income statement. The normal long-term capital gain, the general long-term capital gain, which is 70,000. Then there is long-term capital gain under 112A, which is equal to 1,50,000. Then there is short-term capital gain under section 111A, which is equal to 1 lakh. And there is the other income of 2,50,000. So this is his gross total income or net income. There is no other income, I believe. There is no deduction under chapter 6A, I believe. So this is his net income, 5,70,000. This is a breakup of this 5,70,000 total income. Now he is under 115 BAC. He is paying tax under 115 BAC. So there is 115 BAC anyway. There will be no deduction under chapter 6A. So this is his taxable income of 5,70,000. Okay. Taxable income of 5,70,000. Now let us find out what are the tax rates here. On this 70,000, he has to pay tax at the rate of 20%. Okay. On this long-term capital gain, he has to pay tax at the rate of 10%. Long-term capital gain under 112A. And here there is a tax at the rate of 15%. This is taxable as per slab. And the maximum slab that is possible is 3 lakh, because since he is paying tax under 115 BAC, the slab which is applicable to this person is 3 lakh. Okay, slab applicable to this person is 3 lakh. What does that mean? What does that mean? There is an unexhausted basic exemption limit. Unexhausted basic exemption limit is 50,000. Unexhausted basic exemption limit is 50,000. This 50,000 can be adjusted against any of these incomes, any of these, and only the balance is taxable. Unexhausted basic exemption limit is, it can be deducted either from 70,000 or it may be deducted from 1,50,000, or it may be deducted from 1 lakh. Now, which is beneficial? We can deduct this unexhausted basic exemption limit from that income first, which is taxable at the maximum rate. Which is taxable at the maximum rate. Okay, so the maximum rate is taxable here for long-term capital gain. So first let me calculate tax on long-term capital gain. Tax on long-term capital gain. So since that is taxable at the maximum rate, I am deducting 70,000 from minus 50,000, that is 20,000. 20,000 into 20% will come to 4,000. This is the maximum tax on long-term capital gain. So the basic exemption limit has been now fully utilized. So on 112A, we have to pay tax. But 112A, we know that there is a basic exemption of tax on long-term capital gain under 112A. We know that there is a basic exemption of 1,50,000. 1 lakh. So 1,50,000 minus 1 lakh into 10%. Into 10%. That will come to 5,000. Now tax on short-term capital gain under 111. Tax on short-term capital gain under 111A. It is 1 lakh into 15%, which is equal to 15,000. So we'll add all these together. Now the total tax comes to 24,000. 24,000. See, he is paying tax under the old regime. And he's paying tax under the new regime, 115 BAC. 115 BAC is a section under which he is paying tax. He has chosen, he is in 115 BAC, meaning he can claim rebate. He can claim rebate as income is less than 7 lakh. As income is less than 7 lakh, he can claim rebate, and maximum rebate is 25,000. But there is one point. No rebate for this 5,000. For this 5,000, there is no rebate. No rebate for tax payable under 112A. So rebate can be claimed only for 15,000 plus 4,000. Okay. Rebate can be claimed for only 15,000 and 4,000. That is your tax payable. You can claim up to maximum 25,000. Here rebate can be claimed so for 19,000. Rebate under section 87A, that is for 15,000 plus 4,000, that is equal to 19,000. You cannot claim 24,000 rebate because no rebate for 112A tax. As I told you, even otherwise you are enjoying so many benefits for that tax. So 19,000 is a rebate possible. Balance amount is 5,000 at 4% cess. At 4% cess. 5,000 into 4% comes to 200. So total tax is 5,200. That is your option. Option B is the answer. Okay. 5,200 is the answer. So this is computation of tax liability as well for long-term capital gain. So we have also identified the special rule in the new scheme 115 BAC. If you choose 115 BAC, then rebate is possible up to 7 lakh, but there is no rebate. Whether it is old regime or new regime, there is no rebate for tax payable under 112A. Okay. So we have completed capital gain. We'll wind up the session for the day. We'll meet in the next class. Thank you so much.